of termed out debt.
Yeah. I think there's an element of that. You know, Milton Friedman, very, very quotable, one of his quotes was, monetary policy operates with long and variable lags. I came to think during my time as vice chair that the lags may not be as long as we once thought, because the economy is very financialized. You are correct, the terming out and household balance sheets are in great shape because of all the fiscal transfers. But I guess I'm from Missouri on this. I think that the financial condition tightening in place, and probably what we'll get today, is definitely going to begin to show up in the data. As I said, the big question is we have a red-hot labor market. 6% wage increases aren't consistent with 2% inflation. And so I think that'll really be the issue. How much demand hit do you need to take in order to get that underlying inflation down?
This is really important. So you don't think that there is the same kind of lag time as other people seem to think, that we're seeing it right now in real time as the NASDAQ falls about 1% here and as you see yields rise. Has the market seen enough pain to transmit that?
Well, I think that's probably in the eye of the beholder. I would say thus far that you know, the Fed's made very clear it understands that tightening financial conditions are part of the process for bringing inflation down, and I think this is an element of it. You know, time will tell if it's enough. But I do think today is an important move in the direction. So there's a lot of talk that they might do 100 today. In the end, they didn't. Right. But as you mentioned a moment ago, they essentially got the effect of that, and maybe in a more durable way by putting it into later rate hikes.
You mentioned inertial a couple times. Yeah. So we've got an inertial force of policy, institutional certitude, worried about credibility, and the rest. What is the confidence we can have that they can experience a tightening and then know when to say when, or are they completely ex post dealing with every bit of economic data out there? I mean, to diminish inertial force, you got to get out front of the debate. Yeah. Can they do that? Can you do that?
Here's what I think the challenge is. The inflation overshoot last year was so substantial, and it's turning out to be so persistent, that I think the risk is, and also because I think there's less faith in some of the models, it is really going to be more focused on actually getting tangible evidence of a durable decline in inflation. And what that does mean, related to your question, is that it does mean the risk is overdoing it ex post. But I think if you look at Fed reaction functions pre-pandemic, they were actually quite responsive to the unemployment rate. That was because inflation was so low and stable, there wasn't a month variation in inflation. And so what you ended up with are rate cuts really triggered by rises in unemployment. I think at least for a while, we're not going to see that.
Are you saying the richest job was easy pre-pandemic?
No, I'm saying the entire industry's job was easy.
Everyone's
Yes, everyone. The media, the market, the pros like Clarida, all of them. We had a free pass, John, that we didn't realize we had until we had a natural disaster.
Okay. Just clarify that.
Clarida's never coming back.
Yeah,
Other than that, this is going great.
Make sure. He might be available for Bloomberg Real Yield. Used to be a regular guest, you know.
Really?
Of course, we can make that happen. Mike McKee, you're going through the numbers, sir. What do you see?
Well, I got a question for Rich Clarida here because it's my turn to try to make him angry. Your old job was setting policy. Now your new job is advising people on how to react to policy. And I'm wondering, would you put much, shall we say, money on the idea that the Fed really believes in these numbers going forward? When you look at the 2023 dispersion, and it's still tightly bunched, but it's 6 to 6 over 25 basis point move, and then 2024 and 25, it just all falls apart. I'm wondering if, given the fact that there are no models for what we're coming out of, that we should put much stock in what the Fed thinks is going to happen next year, let alone 24 and 25.
Well, I certainly agree with you. The further out the forecast goes, the less confidence in general you should have in it. On the other hand, I think the dots are, again, just processing it now, I think the dots are conveying the determination of the committee under Chair Powell's leadership to move policy into what they think of as a restrictive territory, and I do put a lot of weight on that. The economic forecasts are obviously dependent also not just on policy, but a lot of other factors. But I do put a lot of weight on what the dots are trying to tell us right now.
I think I agree with you, Rich. We've got to look at the front end too. It's not just about 23. I think my focus coming into this was where's 23, where's the terminal rate? I didn't expect to see 22 at 4.4%.
I didn't either.
4.4%. Think about the work we're doing here through this year so far and where this Fed was in December of last year. In the summary of economic projections, Lisa, in December of last year, and we've talked about this a few times, the Fed had year-end Fed funds at 90 basis points, and now it's gone to 4.4%. That's a major change.
It's an about face at a time when they are saying that forward guidance is dead. It is very not dead. It is so alive. I mean, this is basically them resurrecting forward guidance and saying, here you go. And our guidance is we're going to hold rates high for a very long time.
Yeah, exactly. But actually, John, I would say just since the March meeting, if you look at the distance the committee's traveled on rates, I think at the March meeting, the rate this year was under 3, and as you said, it's 4.4 now. So,
Tom, these are major changes, and I think that's why we're seeing a 2-year yield move out 12 basis points, and why you're seeing currencies like sterling struggle. The equity market snapped back a little bit here. The S&P's down 0.75%, the Nasdaq down 0.9. If I'm sitting here now and thinking about the rest of the world, the Bank of England, I don't know what they're going to do tomorrow. 50 basis points, maybe 75. The ECB's done 75 already. The Riksbank, I'm throwing out a small central bank I know, but it's the world's oldest. It's the OG, the original gangster. The Riksbank did 100 basis points, and how's that worked out? I did do that. I don't know. I can't take it back now.
It's terrible. Yeah.
How's that worked out for Sweden? 100 basis points. This Fed is so dominant at the moment in this FX market.
I agree. They're central banker to the world. I've said that all along. Thank you, Bill Rhodes, for that important idea. Professor Clarida, you had to herd cats at Columbia, and one of the arch cats was the laureate Robert Mundell. He founded our foreign exchange analysis. I'm going to take it Mundell to Jacob Frenkel to Rogoff, Opsfeld-Rogoff, and now we go to Rudy Dornbusch and the rest. How does the dollar fold into your analysis of the optionality that the Fed has, or does strong dollar overcome the choice set that they have where they're squeezed down to limited choices?
Well, I think the dollar accurately reflects we've got a tightening in policy and more on the way. And the interesting thing, Tom, about the dollar is that in some ways movements in the dollar are more relevant for other economies than they are for the U.S. because the U.S. is relatively close. So big moves in the dollar don't really move into U.S. inflation very substantially. There's something that some folks, including Maury Obstfeld, have called a global dollar cycle. I think thus far I've been pleasantly surprised how well the global economy has happened to a really hawkish pivot by the Fed, but obviously something that will need to be followed closely.
But if you take a blended index, Bloomberg Dollar Index is a good idea, and there's emerging market ones you know better than me. If you take it log, so slope matters, the answer is these are not smooth curves. The reaction function of any central bank, including Fed, take the Thai central bank if you want as well, but the reaction function they have is not linear. There's a point where it's a jump condition or a kink or a change. Are we close to that?
Are we close to that? Well, I think depending on how you interpret today's move, we could be close to
DXY 111.36, yen 144. That's a fiction. Why quote yen? Eurodollar 0.9842 on Eurodollar.
I think FX markets and other markets, risk markets more generally, are going to be on the hunt for the foreseeable future and trying to sniff out and determine the pause or the ending of the rate hike cycle. And obviously, I think it's way too soon to be doing that, but that hasn't stopped some folks.
Do you want to give us a month and date for next year?
Probably not.
You can have me on the show next year, and we'll figure it out.
We've got to wait 12 months.
Let's find out, though, because we were talking with Diane Swank a bit ago, several months ago, and she was talking about how the numbers were fanciful, that the Fed projections were not accurately reflecting the reality of what would have to happen in order to bring down inflation. Diane Swank joining us now, chief economist at KPMG. We did see a revision in some of the unemployment rates, as well as just how long they'd have to hold rates high. Do you think that this is going into the realm of reality?
It's still not quite there, and I think Rich is exactly right on that. I think the key issue to really lock onto in this is something, a point that Rich made, that core inflation is looking sticky. The Fed had confirmation bias with the CPI that came out confirming its worst fears, and that is inflation is more inertial. This is something we're also seeing in surveys of businesses versus surveys of consumers. Our own internal surveys, which we hope to publish soon, are showing that businesses have much higher inflation forecasts and unit labor cost forecasts than consumers. And that's important both 1 year and 5 year out because they have decisions over both wages and prices. And that's something that the ECB is looking at as well as a sign that we may be seeing some unmooring of inflation expectations. And I would be interested to hear in what Rich says the unemployment rate has to be. Our own analysis is with these kinds of numbers, we're going to see an unemployment rate that goes above 5% before the inflation, core inflation, dips to 2%. That's a very different scenario than is laid out in the numbers, but you have seen a movement by the Fed to finally acknowledge the pain in the forecast, keeping the unemployment rate in what their new threshold is of 4 to 5% on full employment. The kind of movement we're talking about in an unemployment rate, though, is really consistent with the recession now, and I think that's the way you have to look at this. They're talking about sub-potential growth in both 2022 and 2023, and with that, a rise in the unemployment rate. Not one that I think is enough, but I think their point is pretty with an explanation point on it in terms of forward guidance, as Rich already noted, with the increase of rates, 125 basis points by the end of this year. That's what we expected. We were on an outlier on that, and then an additional 25 basis points next year. That is a lot of rate hikes, and I think we're going to see some nonlinearity to that. I do think that the strong dollar is more a problem abroad, but we don't know what kinds of sins ultra-low rates have papered over in recent years, and that's where I worry about what are we going to see revealed as rates go up higher and in a more dramatic fashion. It's nonlinear.
Rich, you got the floor.
I would simply, hi Diane, I would simply say that if you go back and just look at past U.S. downturns, even in mild recessions, 1960, for example, which I was around for, although 3 years old, the unemployment rate goes up by 1.5%. So even in a mild recession, a rise in the unemployment rate of less than a point would be actually quite unusual. So if you think it's going to take some form of recession to disinflate this economy, then I think probably, yes, something closer to 1.5 rise in the unemployment rate is more consistent with that.
This is a delicate question, but John has mentioned this quite a bit. Hold on. It's a delicate issue right now because we're talking about rising unemployment from a very low rate.
Yes.
But it's going to become an increasingly politicized issue. We're already hearing today in the hearings, the bank hearings in Washington, D.C., some of the Congress members pushing back, saying the Fed's going to torpedo momentum. How does the Fed respond to a politicized issue at a time when nobody wants to see anyone lose their jobs?
Of course, and I think that's why the Jackson Hole speech was so important because, using the phrase, the Fed's going to keep at it, recognizing that there would be some pain. And also the chair and other members of the committee have been quite effective as saying, history shows that in the long run, you can't get and keep maximum employment if you don't have price stability. So I think the way that the committee will address that is to say that we need to get inflation down. We will get inflation down. And over the long haul, that'll be the best way to maximize employment. So I think that will be the way to answer that.
We're 9 minutes away from a news conference with Chairman Powell. If you're just tuning in on TV and radio, 75 basis point hike from the Federal Reserve. The forecasts are absolutely fascinating. If you want to pick up on one thing, the dot plot, aggressively higher compared to where we were at the start of the year and even just a number of months ago. Your equity market down off the back of it by 0.6% on the S&P. On the NASDAQ, we're down 0.7%. The poison, as we've talked about it all week, is at the front end of the yield curve, up 10 basis points, 4.07% on a 2-year yield. Yields up, dollar stronger, sterling weaker, 112 handle on cable. Remarkable stuff. The dollar index up by another 1%, a 111 handle, Tom, on the dollar index, a 111 handle.
Absolutely fascinating. And I go to foreign exchange just as the deepest market here, and yen is maybe not where it should be, but everything else, John, has moved to the point where it's a reset on the screen that we've rarely seen in umpteen years.
So how does the conversation change from here? We've had an aggressive shift in the dot plot. Connor Sen of Bloomberg opinion out on Twitter wrote this. Just allow me to read this one out loud. Will the 23 dots move up in December, March, or will the 24-25 cuts be pulled forward? Is that going to be the new market debate now? Rich Clarity, your thoughts on that? What's the risk here? The 23 dots have to be pushed up, or those cuts in late 24 into 25 have to come in?
I think that both in terms of economics and in terms of what they communicated, the committee is going to really need to push back against this idea that they'll do all the heavy lifting this year to get the rates up, and then immediately at the first sign of a slowdown in the economy, which is part of the plan, that they would cut rates. And it was striking to me coming out of the July meeting how some of the more dovish members of the committee pushed back against that. And I would imagine the chair will have an opportunity in 8 minutes. He'll get that question. But yes, I think, in terms of market pricing, I think markets will continue to romance a U-turn by the Fed, and I think they'll be proved wrong.
John, I just saw the dot plot from Brian Chapata, our wonderful, wonderful bond guide with Bloomberg Opinion. I've never seen a dot plot like that. It is
available on the Bloomberg terminal.
It looks like I don't know how to do that. It looks like pickup sticks. It looks like pickup. Were you good at pickup sticks?
I was terrible at that.
I was the worst. That's what the dot plot looks like.
Diane Swan,
I don't even know where Bullard is in it.
These are complex issues, Diane. The simple question is the rate cut one for Chairman Powell. How do you expect him to tackle that in about 6 minutes?
Well, I think really this is the biggest issue for the Fed is that they're choosing the lesser of two evils. And I think Rich really hit the nail on the head in terms of, the trade-off. It's a much harder sell than it is to actually do it than it is to say it. But the reality is we take a mild recession today and eradicate inflation now because we know the mistakes of the past. That doesn't mean the Fed won't make a whole new set of mistakes, which is what I'm worried about. But the flip side is if we allow inflation, this inertial inflation that's proven to be more sticky now, to get entrenched, you have to take a much deeper, scarring recession later on to eradicate it. Right. And the back-to-back recessions were really bad in the early 1980s, and that's what they're trying to avoid, those mistakes. Now, like I said, in avoiding those mistakes, they may make a whole new set of mistakes with the rapid rate of increases and the catch-up that we've seen. Not that they didn't need to do that, but that in and of itself is destabilizing, and I do worry about where are we going to see something else blow up in financial markets.
Diane, back to Bank One and back to your work at Michigan, and of course their consumer confidence is definitive. You have always followed the consumer. Forget about Richard Clarida and all the fancy people like Diane Swank. How will the consumer respond? How will the consumer respond every day to what we're talking about, this new rate regime? How does consumption respond?
Well, we're already seeing it. We're already seeing it in the housing market, which is in a recession. We're already seeing it in vehicle sales. Vehicles, they're still selling them for high prices, but they're not selling a lot of them. And I think we're going to see, it takes a while for the declines in the housing market to spill over. The single largest trigger to additional consumer spending, that is spilling over. We've had 4 months in a row of declines in appliances, furniture, big ticket items for the home. Those all are going to start to show up as we get into the fourth quarter and we move into 2023. And I think what's important too is the pent-up demand in services. Let's face it, you can't replace holiday parties canceled due to the pandemic. And so you're going to have a much weaker consumer as we get into 2023. And I do think you'll see an actual contraction in growth.
John,
I think the Fed is still a bit fanciful on their forecast.
30-year mortgage, 6.4%. I didn't know that.
And you heard Diane just there. Even with that, this Fed is still fanciful on its growth forecast. Diane, just finally, before we let you go, and thanks for being with us, as always, question for Chairman Powell today. What's outstanding for you besides that?
The question for Chairman Powell is, really, what is the lesser of two evils and how far are you willing to go and how much unemployment are you willing to take? Because that's the question that wasn't answered by these forecasts.
Diane Swank of KPMG. As always, Diane, just absolutely brilliant. Rich, maybe you can help us with that. What a tough message to sell to the public, that higher unemployment is the price worth paying to get inflation lower. How do you make that case to the public?
I think really the options are limited beyond what the chair has already said, that over the long haul, to get maximum employment, we need price stability. I'm not saying that it will be widely shared, but that is the castor oil now that the patient needs in order to avoid a much worse dynamic down the road.
So Diane was talking about the potential for something to blow up as we embark on this path. What do you think is the most likely candidate?
Well, it may not be in the U.S. As I said, historically, Fed tightening cycles do create some collateral damage, and obviously, depending upon the country or countries and the repercussions from that, that would be one area. One thing I would say, though, is we went into the pandemic with the financial system in good shape, and obviously, households have about $2 trillion in the aggregate in saving, and so there are a lot of cushioning elements to the picture right now. But I guess if there is a wild card, it's probably a rate hike cycle impinging somewhere globally that's not obvious right now.
Our currency, your problem, seems to be the focus at the moment.
John Connolly.
When does it become our problem here in America, for this Fed specifically?
Well, it obviously becomes a problem if it becomes systemic globally and leads to a sharp global downturn and all the consequent elements of that. And of course, everyone's hiking. Almost everyone's hiking now, except Mr. Kuroda in Japan. So we've got a global hiking cycle. Remember, in the last cycle, the ECB never got to zero, let alone off negative. So this is a different dynamic, and that just elevates the risks.
Lift the veil on what's about to happen here. Does the chairman have a smartphone in front of him with the S&P 500, the Nasdaq on, and yield spreads?
Not
does he have any insight on what's moving?
Not that I know of. When we had our meetings in person, the meeting would end, and then the chair would prepare, but I don't think so.
Tom, do you think that would help the chairman if he could see what the Nasdaq was doing on decision day?
He's not Greenspan. Greenspan would really care. Greenspan really cared about Chapter 23 and Name Your Basic Textbook, and he really cared about financial markets and markets. I haven't seen that from Jerome Powell.
Because this equity market is ripped in these news conferences. I tell you what, the way it works around this table is that Lisa often looks over at me and looks at the equity market and says, what's happening here? I do not get this.
Yeah, well, and that's, I think, the question that I would have for him is right now, is he happy to see the market reacting the way it is?
I'm going to vamp off of Richard Clarida and say, to me, he is central banker to the world. I think of Ecuador, 1998, and on and on. You can go back. I'm sorry, he is the central banker of the international community in this press conference.
The international community is not too pleased with him.
Wait till you see Pacific Rim open. I looked at ADXDY, and we're down 2 standard deviations.
You talk about rewriting speeches. Governor Bailey and that Bank of England decision tomorrow.
And John, seriously, with great respect for what you and I witnessed in London, are they an emerging market?
Tom, the currency's traded that way on several occasions. I would say at this point it's going to be very, very difficult for a rate hike to gain any traction, given what this dollar's been up to. Chairman Powell's walked into the room. He's going to start this news conference any second from now. Your equity market is lower, yields are higher, your dollar is a whole lot stronger. Here is the chairman of the Federal Reserve after a 75 basis point rate hike.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 0.75 percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Recent indicators point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. while weaker economic growth abroad is restraining exports. As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Job gains have been robust, with employment rising by an average of 378,000 jobs per month over the last 3 months. The labor market continues to be out of balance, with demand for workers substantially exceeding the supply of available workers. The labor force participation rate showed a welcome uptick in August, but has little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer-run normal level. Inflation remains well above our 2% longer-run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the consumer price index was 8.3%, and the change in the core CPI was 6.3%. Price pressures remain evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025, still above the median estimate of its longer-run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Hi, Chair Powell. Thank you for taking our questions. Gina Smilik from the New York Times. I wonder if you could give us a little detail around how you'll know when to slow down these rate increases and how you'll eventually know when to stop.
So I will answer your question directly, but I want to start here today by saying that my main message has not changed at all since Jackson Hole. The FOMC is strongly resolved to bring inflation down to 2%, and we will keep at it until the job is done. So the way we're thinking about this is the overarching focus of the committee is getting inflation back down to 2%. To accomplish that, we think we'll need to do two things in particular: to achieve a period of growth below trend and also some softening in labor market conditions to foster a better balance between demand and supply in the labor market. So on the first, committee's forecasts and those of most outside forecasters do show growth running below its longer run potential this year and next year. On the second, though, so far there's only modest evidence that the labor market is cooling off. Job openings are down a bit. As you know, quits are off their all-time highs. There's some signs that some wage measures may be flattening out but not moving up. Payroll gains have moderated, but not much. And in light of the high inflation we're seeing, we think we'll need to, and in light of what I just said, we think that we'll need to bring our funds rate to a restrictive level and to keep it there for some time. So what will we be looking at, I guess, is your question. So we'll be looking at a few things. First, we'll want to see growth continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2% before we would consider that.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Can you talk about how you factor in the variable lags on inflation and the extent to which the outlook for rates should be seen as linear in the sense that you keep raising rates? Or can you envision a time when there's a pause to kind of look at what has been wrought in the economy from the rate increases? Thank you.
Sure. So, of course, monetary policy does famously work with long and variable lags. The way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect economic activity fairly quickly, within a few months. But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation. So that's how we think about that. Your second question, sorry, was?
Is there a point in time you can see pausing? Is it linear that you keep raising rates, or is there? Oh, I'm sorry. I should know better than to not talk with my microphone.
You should know better than to answer your second question.
Oh, there you go. Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out what has happened to the economy and give time to catch up in the real economy, the rate increase time to catch up in the real economy? Thank you.
So I think it's very hard to say with precise certainty the way this is going to unfold. As I mentioned, what we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers is people's views as of today, as of this meeting, as to the kind of levels that will be appropriate. Now, those will evolve over time, and I think we'll just have to see how that goes. There is a possibility, certainly, that we would go to a certain level that we're confident in and stay there for a time. But we're not at that level. Clearly, today we've just moved, I think, probably into the very lowest level of what might be restrictive. And certainly, in my view and in the view of the committee, there's a ways to go.
Rachel. Hi, Chair Powell. Rachel Siegel from The Washington Post. Thank you for taking our questions. The projections show the unemployment rate rising to 4.4% next year. And historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
Right. So you're right. In the SEP, there's what I would characterize as a relatively modest increase in the unemployment rate from a historical perspective, given the expected decline in inflation. Now, why is that? So really, that is what we generally expect. Because we see the current situation as outside of historical experience in a number of ways, and I'll mention a couple of those. First, and you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible, I'll say, that job openings could come down significantly, and they need to, without as much of an increase in unemployment as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer run inflation expectations have generally been fairly well anchored. And as I've said, there's no basis for complacency there. But to the extent that continues to be the case, that should make it easier to restore price stability. And I guess the third thing I would point to that's different this time is that part of this inflation is caused by this series of supply shocks that we've had, beginning with the pandemic and really with the reopening of the economy, and more recently amplified and added to by Russia's invasion of Ukraine, have all contributed to the sharp increase in inflation. So these are the kinds of events that are not really seen in prior business cycles. And in principle, if those things start to get better, and we do see some evidence of the beginnings of that, it's not much more than that, but it's good to see that. For example, commodity prices look like they may have peaked for now. Supply chain disruptions are beginning to resolve. Those developments, if sustained, could help ease the pressures on inflation. So let me just say how much these factors will turn out to really matter in this sequence of events, it remains to be seen. We have always understood that restoring price stability while achieving a relatively modest decline, or rather increase in unemployment, and a soft landing would be very challenging. And we don't know. No one knows whether this process will lead to a recession, or if so, how significant that recession would be. That's going to depend on how quickly wage and price inflation pressures come down, whether expectations remain anchored, and whether, also do we get more labor supply, which would help as well. In addition, the chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer. Nonetheless, we're committed to getting inflation back down to 2% because we think that a failure to restore price stability would mean far greater pain later on.
Just to follow up on one small thing, are vacancies still at the the top of your list in terms of understanding the labor market and how much room there is there?
Yes, vacancies are still almost 2-to-1 ratio to unemployed people. That and quits are really very good ways to look at how tight the labor market is and how different it is from other cycles, where generally the unemployment rate itself is the single best indicator. We think those things have for quite a time now really added value in terms of understanding where the labor market is.
Nick?
Nick Timmeros of the Wall Street Journal. You said not too long ago in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about, as the data come in, where that destination is, how it's moving up if inflation doesn't perform as you expect. Do you want to have a policy rate that's above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
Well, so again, we believe that we need to raise our policy stance overall to a level that is restrictive. And by that I mean is meaningfully putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lags, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know. You look at where rates are, real and nominal in some cases. You look at credit spreads. You look at financial conditions indexes. We also, I would think, and you see this this is something we talked about today in the meeting and talk about in all of our meetings, and you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about you measure those against some sort of forward-looking assessment of inflation expectations. I think you would see at that time, you'd see positive real rates across the yield curve, and that is also an important consideration.
Howard.
Hi, Howard Schneider with Reuters. Thanks for the opportunity. I just want to be clear on the steps. You say it's meeting by meeting, but it sure looks like we're going 75, 50, 25. Is 75 next month the baseline?
So we make one decision per meeting, and the meeting decision we made today was to raise the federal funds rate by 75. You're right that the median for the year end suggests another 125 basis points in rate increases, but there's another fairly large group that saw 100 basis points addition to where we are today. So that would be 25 basis points less. So we're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that. I would say that we're committed to getting to a restrictive level of for the federal funds rate and getting there pretty quickly, and that's what we're thinking about.
So just as a follow-up to that, I'm wondering about the sort of risk management considerations here. Given there's some discussion now of overdoing it, what's the incentive to continue front-loading right now? Is it lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still as strong as it is?
So what we've seen is our expectation has been that we would begin to see inflation come down, largely because of supply side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen some supply side healing, but inflation has not really come down. If you look at core PCE inflation, which is a good measure of where inflation is running now, if you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation, and that's not where we expected or wanted to be. So what that tells us is that we need to continue, and we can keep doing these, and we did today do another large approach the level that we think we need to get to. And we're still discovering what that level is, but people are writing that down in their SEP where they think policy needs to be. So that's how we're thinking about it.
Let's go to Colby. Thank you. Colby Smith with the Financial Times. Chair Powell, how should we interpret the fact that core inflation is still not forecast in the SEP to be back to target in 2025? And yet the dot plot projects cuts as early as 2024. And does that mean there's a level of inflation above the 2% target that the Fed is willing to tolerate?
So I guess core is at 2.1 in 2025, and in the median, and headline is at 2.0. So that's pretty close. I mean, we write down our forecasts and we figure out what the median is and we publish it. So it's not. I mean, I would say that if the economy followed this path, this would be a pretty good outcome. But you're right, it is a tenth higher than 2%.
Okay, just as a quick follow-up, I mean, if the concern is that underlying inflation is becoming more entrenched perhaps each month, then why forego the more aggressive 100 basis point increase today? And does that risk having to do more later on?
Yeah, so we, as we said, at the last press conference and in between that one and this one, we said that we would make our decision based on the overall data coming in. So if you remember, we got a surprisingly low reading in July, and then a surprisingly high reading for August. So I think you never want to overreact too much to any one data point. So if you look at them together, and as I just mentioned, if you really look at this year's inflation, 3, 6, and 12-month trailing, you see inflation is running too high. It's running 4.5% or above. You don't need to know much more than that. If that's the one thing you know that this committee is committed to getting to a meaningfully restrictive stance of policy and staying there until we feel confident that inflation is coming down. That's how we think about it.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask about the balance sheet. You all have left open the possibility that you might sell mortgage-backed securities, but we've seen significant slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering whether conditions there might affect your plans for how quickly you have the runoff on the MBS side.
So what we said, as you know, was that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now, and not something I expect to be considering in the near term. It's just it's something I think we will turn to, but the time for turning to it has not come and is not close.
Well, and will conditions in the housing market affect that decision?
I think a number of things might affect that decision, but the main thing is we're not considering that decision, and I don't expect that we will anytime soon.
Neil.
Thanks. Neil Irwin with Axios. A number of commentators have come to the view, and including over at the World Bank, that simultaneous global tightening around the world creates a risk of a global recession that's worse than is necessary to bring inflation down. How do you see that risk? How do you think of coordination with your fellow central bankers? And is there much risk of overdoing it on a global level?
So we actually, my colleagues and I, a number of my FOMC colleagues and I just got back from one of our frequent trips to Basel, Switzerland, to meet with other senior central bank officials from around the world. We are in pretty regular contact, and we exchange. Of course, we all serve a domestic mandate, domestic objectives, in our case, the dual mandate, maximum employment and price stability. But we regularly discuss what we're seeing in terms of our own economy and international spillovers. And it's a very ongoing, constant kind of a process. So we are very aware of what's going on in other economies around the world and what that means for us and vice versa. The forecast that we put together, that our staff puts together and that we put together on our own, always try to take all of that into account. I mean, I can't say that we do it perfectly, but it's not as if we don't think about the policy decisions, monetary policy and otherwise, the economic developments that are taking place in major economies that can have an effect on the U.S. economy. That is very much baked into our own forecast and our own understanding of the U.S. economy as best we can. It won't be perfect. So you know, I don't see it's hard to talk about collaboration in a world where people have very different levels of interest rates. If you remember, there were coordinated cuts and raises and things like that at various times, but really we're in very different situations. But I will tell you that our contact is more or less ongoing, and it's not coordination, but there's a lot of information sharing, and we all, I think, are informed by what other important economies that are important to the United States are doing.
Craig Torres from Bloomberg. Chair Powell, you talked about some ways the higher interest rates are affecting the economy, but we've also seen a resilient labor market with durable consumption, strong corporate profits. And I'm wondering what your story is on the resilience of the economy. After all, you and your colleagues said, well, we started tightening in March when we were talking about interest rates in the future, and indeed, Treasury rates moved up, so we should have had a lot of tightening taking effect. Why is the economy, in your view, so resilient, and does it mean that we might need a possibly higher terminal rate?
You're right, of course. The labor market in particular has been very strong. But there are the sectors of the economy that are most interest rate sensitive are certainly showing the effects of our tightening. And of course, the obvious example is housing, where you see declining activity and of all different kinds, and housing price increases moving down. So we're having an effect on interest-sensitive spending. I think through exchange rates, we're having an effect on exports and imports. I think so. All of that's happening. But you're right. And we've said this. You know, this is a strong, robust economy. People have savings on their balance sheet from the period when they couldn't spend and where they were getting government transfers. There's still very significant savings out there, although not as much at the lower end of the income spectrum, but still some savings out there to support growth. The states are very flush with cash. So there's a good reason to think that this will continue to be a reasonably strong economy. Now, the data sort of are showing that growth is going to be below trend this year. We think of trend as being about 1.8% or in that range. We're forecasting growth well below that, and most forecasters are. But you're right. There's certainly a possibility that growth can be stronger than that. And that's a good thing because that means the economy will be more resistant to a significant downturn. But of course we are focused on the thing I started with, which is getting inflation back down to 2%. We can't fail to do that. If we were to fail to do that, that would be the thing that would be most painful for the people that we serve. So for now, that has to be our overarching focus, and you see that, I think, in the SEP, in the levels of rates that we'll be moving to reasonably quickly, assuming things turn out roughly in line with the SEP. So that's how we think about it.
Thank you, Mr. Chairman. In a world of euphemisms that we live in here with below-trend growth and a modest increase in unemployment, I'm wondering if I could ask you a couple of direct questions for the American people. Do the odds now favor, given where you are and where you're going with interest rates, favor a recession? 4.4% unemployment is about 1.3 million jobs. Is that acceptable job loss? And then given that the data you look at is backward-looking and the lags in your policy are forward-looking and you don't know what they are, how will you know, or will you know, if you've gone too far?
So I don't know what the odds are. I think that there's a very high likelihood that we'll have a period of what I've mentioned is below trend growth, by which I mean much lower growth, and we're seeing that now. So the median forecast, I think, this year for among my colleagues and me was 0.2% growth. So that's very slow growth, and then below trend next year. I think the median was 1.2, also well below. So that's a slower. That's a very slow level of growth, and it could give rise to increases in unemployment. But I think that is something that we think we need to have, and we think we need to have softer labor market conditions as well. We're never going to say that there are too many people working, but the real point is this. Inflation, what we hear from people when we meet with them is that they really are suffering from inflation. And if we want to set ourselves up, really light the way to another period of a very strong labor market, we have got to get inflation behind us. I wish there were a painless way to do that. There isn't. So what we need to do is get rates up to the point where we're putting meaningful downward pressure on inflation. And that's what we're doing. And we certainly don't hope. We certainly haven't given up the idea that we can have a relatively modest increase in unemployment. Nonetheless, we need to complete this task.
Well, how will you know, or will you know, if you've gone too far?
It's hard to hypothetically deal with that question. I mean, our really tight focus now continues to be ongoing rate increases to get the policy rate up where it needs to be. And as I said, you can look at this SEP as today's estimate of where we think those rates would be. Of course, they will evolve over time.
Chris Rugaber.
Thanks. Chris Rugaber, Associated Press. I wanted to follow up with what you just mentioned about the labor market. You've said several times that to have the labor market we want, we need price stability, and you've suggested maybe there isn't a trade-off in the long run. But in the short run, there is a lot of concern, as people have been expressing here, about higher unemployment as a result of these rate hikes, or as a result of the rate hikes. So can you explain, though, what about high inflation now threatens the job market? I mean, you seem to suggest that high inflation will eventually lead to a weaker job market. So can you spell that out a little more for the general public and how that would work?
So for starters, people are seeing their wage increases, their wage increases eaten up by inflation. So if your family is one where you spend most of your paycheck, every paycheck cycle, on gas, food, transportation, clothing, basics of life, and prices go up the way they've been going up, you're in trouble right away. You don't have a cushion. And this is very painful for people at the lower end of the income and wealth spectrum. So that's what we're hearing from people is, it's very much that inflation is really hurting. So how do we get rid of inflation? And as I mentioned, it would be nice if there were, a way to just wish it away, but there isn't. We have to get supply and demand back into alignment. And the way we do that is by slowing the economy. Hopefully, we do that by slowing the economy, and we see some softening in labor market conditions, and we see a big contribution from supply side, improvements and things like that. But none of that is guaranteed. In any case, our job is to deliver price stability, and I think you can think of price stability as an asset that just delivers large benefits to society over a long period of time. We really saw that for a long time. The United States had 2% inflation, didn't move around much, and that was enormously beneficial to the public that we serve. And we have to get back to that and keep it for another long period of time. To pull back from the task of doing that is you're just postponing. The record shows that if you postpone that, the delay is only likely to lead to more pain. So, I think we're moving to do what we need to do and do our jobs, and that's what you see us doing.
Thank you for taking the question, Mr. Chairman. Edward Lawrence for Fox Business. So you had said that Americans and businesses need to feel some economic pain as we go forward. How long from here should Americans be prepared for that economic pain?
How long? I mean, it really depends on how long it takes for wages and more than that, prices to come down, for inflation to come down. And what you see in our projections today is that inflation moves down, significantly over the course of next year, and then more the next year after that. And I think once you're on that path, that's a good thing, and things will start to feel better to people. They'll feel lower inflation. They'll feel that the economy's improving, and also if our projections are close to right, you will see that that the costs in unemployment they're meaningful, and they're certainly very meaningful to the people who lose their jobs. And we talk about that in our meetings quite a lot. But at the same time, we'd be setting the economy up for another long period. This era has been noted for very long expansions. We've had 3 of the 4 longest in measured history since we got inflation under control. And that's not an accident. So when inflation is low and stable, you can have these 9, 10, 11, 10-year, expansions, and you can see what we saw in 2018, 19, and 20, which was very low unemployment, the biggest wage gains going to people at the low end of the spectrum, the smallest racial gaps that we've seen in since we started keeping track of that. So we want to get back to that, but to get there, we're going to have to get supply and demand back in alignment, and that's going to take tight monetary policy for a period of time.
As a follow-up, what is that economic pain in your mind? Is it job losses? Is it higher interest rates on credit cards? What is that economic pain?
So it's all of those things. Higher interest rates, slower growth, and a softening labor market are all painful for the public that we serve. But they're not as painful as failing to restore price stability and then having to come back and do it, down the road again, and doing it at a time when actually now people have really come to expect, high inflation. If the concept of high inflation becomes entrenched in people's economic thinking about their decisions, then sort of getting back to price stability, the cost of getting back to price stability just rises, and so we want to avoid that. We want to act aggressively now and get this job done and keep at it until it's done.
Thank you, Chairman Powell. Nicole Goodkind, CNN Business. Existing home sales have fallen for 7 months straight. Mortgage rates are at their highest level since 2008. Yet mortgage demand increased this week, and housing prices are still elevated. Now, at the end of your June press conference, you mentioned plans to reset the housing market. I was wondering if you could elaborate on what you mean when you say reset and what you think it will take to actually get there.
So when I say reset, I'm not looking at a particular specific, set of data or anything. What I'm really saying is that we've had a time of a red hot housing market all over the country, where, famously houses were selling to the first buyer at 10% above the ask before even seeing the house, that kind of thing. So there was a big imbalance between supply and demand. Housing prices were going up at an unsustainably fast level. So the deceleration in housing prices that we're seeing should help bring sort of prices more closely in line with rents and other housing market fundamentals. And that's a good thing. For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford houses again. And I think we probably in the housing market have to go through a correction to get back to that place. There are also longer run issues though with the housing market, as you know, where it's difficult to find lots now close enough to cities and things like that. So builders are having a hard time getting zoning and lots and workers and materials and things like that. But from a sort of business cycle standpoint, this difficult correction should put the housing market back into better balance.
Shelter made up such a large part of this hot CPI report that we saw. Do you think that there is a lag and that we will see that come down in the coming months, or do you think that there's still this imbalance that needs to be addressed?
I think that shelter inflation is going to remain high for some time. We're looking for it to come down, but it's not exactly clear when that will happen. So it may take some time. So I think hope for the best, plan for the worst. So I think on shelter inflation, you've just got to assume that it's going to remain pretty high for a while.
Okay, we'll go to Jean for the last question. Hi, Jean Young with Market News. You've talked about the need to get real rates into positive territory, and you said earlier that policy is just moving into that territory now. So I'm curious, how restrictive is rates at 4.6% expected? Is that expected to be next year? How restrictive?
So I think if you look, when we get to, let's assume we do get to that level, which I think is likely, what you're going to do is you're going to adjust that for some forward looking measure of inflation. And, that could be, you pick your measure. It could be, there are all kinds of different things you can pick and you get. But what you'll get is a positive number. In all cases, you will get forward inflation expectations in the short term, I think, that are going to be, assuming that we're doing our jobs appropriately, that will be significant. So you'll have a positive federal funds rate at that point, which could be 1% or so. But I mean, I don't know exactly what it would be, but it would be significantly positive when we get to that level. And let me say, we've written down what we think is a plausible path for the federal funds rate. The path that we actually execute will be enough. It will be enough to restore price stability. So this is something that, as you can see, they've moved up, and we're going to continue to watch incoming data and the evolving outlook and ask ourselves whether our policy is in the right place as we go. Thank you very much.
Chairman Powell, wrapping things up early. I had to rush to grab the microphone just then, TK. I think the message here, if you've got more questions, see my speech in Jackson Hole, Wyoming.
I think that would be true.
For more.
Rinse, repeat.
There we go. Rich Clowder alongside us, the former Vice Chair of the Federal Reserve. I want to whip through the price action to get you started. Big turnaround. Going into this, deeply negative, then positive for a while. The Nasdaq was up about 1%. It's now up 0.1%. We fade that in the last 10 minutes or so. We're down about 0.1% on the S&P 500. Yields at the front end were higher by more than 10 basis points.
All over the place.
5. Now up just 5 on a 2-year, 4% on a 10-year, 353. We're down about 4 basis points. We talked about that dollar strength. It sticks. Sterling 113.20, negative 0.5%. This dollar a whole lot stronger. Chairman Powell telling you pretty clearly they're in it for the long haul. Take a listen to what the chairman had to say.
What we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%. There is a possibility, certainly, that we would go to a certain level that we're confident in and stay there for a time. But we're not at that level. Clearly, today we've just moved, I think, probably into the very lowest level of what might be restrictive. And certainly, in my view and in the view of the committee, there's a ways to go.
Rich, you know how this works. I've already had the messages. This was it. This was peak hawkishness. Does it get any more hawkish than this? What's your response to that?
Well, I think, as Lisa said, it was a hawkish 75. They didn't do the 100, but in some ways I think it was more hawkish because it shows a committee resolved to move into restricted territory, keep at it till the job is done, compelling evidence on inflation. And near the end, Chair Powell said, and it will be enough in terms of the rate hikes. So instead of getting into what the dots are saying, he said, it will be enough. And I think that's the first time he's actually used that phrase. So
what's important, at least, is the body language of the former vice chairman when he agreed with Chairman Powell and what he was saying. There was a very physical response.
Do you think we needed a clarity?
From Mr. Clarida.
Oh my gosh! I got to watch the body language.
Like we have a Bramo cam. I think we need a clarity.
I've already had the messages, though, Lisa. It will be enough is the new whatever it takes.
Yeah. Well, and what will it take? Will it take another 75 basis points the next meeting, Rich?
I think so. I mean, if you do the arithmetic, the dots, and I think pay attention to the dots at least for this year, show another 125, and you do 75/50s. It looks like the path of least resistance right now.
Does it make sense to you that the market rallied after this?
I've noticed this year some of the press conferences, I think, that skew hawkish. The markets, especially the stock markets, love it. So maybe I'll have a good answer tomorrow when I see where it settles down. But Chair Powell is getting good at these, so yes.
Rich, can you tell me how you respond to that, though? When you've all had this meeting, the chairman's done exactly what you expected him to do in the news conference. For you all sitting in the committee, it sounds very hawkish. You come out and you see the Nasdaq up 0.7, the S&P up 0.5%. Does that matter to any of you? Do you look at the end of the day prices?
Well, I did.
That's meaningful.
I won't speak for my other former colleagues. I did. What I oftentimes found is I more or less understood the bond market reaction in the 30 minutes after the announcement. I only was batting about a 50% coin flipped on the equity market reaction. So I think there's a little bit of cross-market churning on statement day.
The reason we ask this is because I think that Neil Kashkari, the Minneapolis Fed president, speaking to our colleagues Tracy Alloway and Joe Weisenthal on their podcast, Odd Lots, he was pretty clear about where he wanted this market to be, how he wanted financial conditions to respond. That's not new, but do you think there is more of a focus on that this time around?
Yes, and as I mentioned, I think coming out of the July meeting, which some, not I, took as being a dovish pivot, which did not happen, you did see Neil, President Kashkari and President Daley really pushing back on this idea that the Fed would hike this year and then immediately next year start to cut. And you definitely saw Chair Powell pushing back on that again today.
I've got two questions. One of them is very general and the other sort of bow tie baloney. The first one is there too much communication? You and I remember Columbia's Arthur Burns. We'd look at the smoke signals.
Yeah.
Then we had to worry about what lunch Chairman Greenspan had in his briefcase. And now we have just overt communication. I would say you were actually fairly quiet compared to some of the presidents and such. Do we have too much are we drowning in Fed communication?
Well, what I would say is I think it's valuable for the chair to do the press conferences, and also he's up there doing testimony around the clock. So yes, but in terms of signal to noise, I think you do think about that in terms of different points in the cycle. I wouldn't necessarily want to characterize it. Now, what I would say definitively from my view is the hawkish pivot we've seen since the March meeting is remarkable because you'd have to go back decades to when we were starting our career to see a similar pivot without all that communication. And I think it's worked so far in the sense that we've had the tightening in financial conditions relatively orderly. And in a way, as you say, on press conference day markets go up, we've had it because the chair has been willing to own the guidance. And as long as the chair owns the guidance in the press conferences and the like, that can enable some of the noise to be filtered out. I think where it gets challenging is when you have a lot of noise and the chair is not owning the message. But Jay Powell's owning this message and owning this guidance.
I want to go to early in the press conference. Not once, but twice it came up. This Clarida-like word, nonlinear.
Yeah.
Of course, this is your meat and potatoes with Gertler and Galley and the rest of it. Fernandez Villaverde at Penn is excellent on this. He's got 38-page slides of nonlinearity, and the summary of it from your mortals like me is we're more blind when we're nonlinear than our fancy, simple, linear models. How blind is this Fed forward if we assume we're going to get nonlinear conditions, kinks, jump conditions, surprises along the way?
Yeah. So excellent point. I've not read that paper, but the general proposition is a lot of modeling, including my work with Gertler and Galley, usually linearizes those nonlinear models, and so you simplify the analysis. But where I think it is relevant, Tom, in this environment is the labor market and the pandemic shock and the reopening are such a Six Sigma event that whatever the old normal was pre-pandemic we're not there yet. And so in some ways, I think the Fed and other central banks are sort of navigating their way. And that's why Chair Powell will say things like, inflation's too high, or we want inflation to be lower. They're trying to simplify a very complex environment. And I think also, Tom, because it's nonlinear, probably less model reliant than in the past.
Do we risk giving the American public, and particularly the middle class, a Six Sigma labor event, a Six Sigma standard of living event where we put them flat on their back?
Well, I hope not, and I think we can avoid it because, as I said, inflation expectations now are reasonably well behaved. That means that the Fed has less heavy lifting to do than Paul Volcker did, but there's no doubt that the economy is now out of balance, and it's been quite a long time since it's been out of balance, and right now the Fed is the game in town that's trying to push against that.
When it comes to our good friend Mike McKee, the chairman is often a bit evasive. I don't know if you've got any inside information on as to why. But he asked a little question about how will you know if you've done too much? How do you think they will know?
Well, as I tried to suggest in the earlier segment, I think that is a real risk in this cycle because the luxury of the pre-pandemic, the Greenspan, Bernanke, Yellen, and Powell term one, which I served with the team, was because inflation had been so low and stable and globalization and all of that, the Fed had the luxury of being very nimble to cut rates when unemployment ran up and to hike rates when unemployment went down. And I think that the challenge right now is because inflation is high and persistent, persistent, that the risk is skewed to doing too much. But because of the nonlinearities and other things you all have mentioned, they really can't afford to declare victory. They can't say mission accomplished and then 6 months later have inflation pick up again. And I think Chair Powell and the group is really trying to protect the institutional integrity of the Fed. And I think the risk there will be doing too much.
Mike McKee ran out of that news conference, got to the camera. He joins us right now. Mike, I sense you weren't satisfied with your response from the Fed chair in that news conference.
Well, he's not going to use the recession word, even though I goaded him to do that because that would make its own headlines. But he is pretty clear that the Fed is anticipating a recession and that it is going to send the unemployment rate higher. You notice over the last couple of meetings, he's gone from soft landing to softish landing to now some pain. There is a definite tilt towards an economic contraction coming here. And I think he's trying to prepare the markets for it. Whether he's doing a really good job of preparing the American people for it is another question.
And Rich, this really goes to the question of why markets still believe there will be a pivot. And you're still getting commentary. Let's see what the Fed really does when the unemployment rate actually rises, when they get political pushback. And there are going to be notes saying, no way are they going to allow this. What's your response?
My response would be the committee is surprisingly unified on this point in rhetoric and in their projections. Secondly, I understand why markets are doing that, because if you just ran a regression of the Fed under Greenspan, Bernanke, Yellen, and Powell, it would basically reflect that view that the Fed's very sensitive to the unemployment rate. They can't afford to do that now as long as inflation in the labor market is overheated. So at least until inflation comes down compellingly, as the chair said, I think you want to fade that dovish pivot sentiment.
Lisa's sort of sneaking in the politics here, and I think we've got to pick up on this.
Yeah.
Senator Warren, during this news conference, tweeted out the following: the Chairman Powell just announced another extreme interest rate hike while forecasting higher unemployment. I've been warning that Chair Powell's Fed would throw millions of Americans out of work, and I fear he's already on the path to doing so. The November decision, as you're well aware, is within a week of the midterms. How would you respond to the politics on the horizon to all of this, Rich, and what's forming right now already?
Well, what's forming now is obviously, and there's more to come, given the pain that the chair refers to, and these projections. I think by emphasizing, not only running down the dots, but by putting the projections out there and really embracing them, as the chair did today, I think that the committee will try to tee up 75 as the expectation, and I think that's what they have to do. So,
do you worry about this institution though becoming a political football once unemployment starts to climb?
I worry about it, but as a student of monetary history, it's not unheard of. I mean, Chair Volcker dealt with that, as he wrote about in his memoirs and others. And so I think that one of the consequences of the inflation overshoot is that it's going to trigger that pressure. But I think the institution will survive it.
Did you basically hear Fed Chair Jay Powell say that the chances of a soft landing are almost non-existent, and that we're heading toward a recession, and the question is just how deep it's going to be?
I think the way, Lisa, he answered that question is that the Fed sees below trend growth for several years.
How do you translate that?
And I think historically, with that rise in the unemployment rate, I don't think we've ever had a cycle with a 1 percentage point rise in the unemployment rate, which has not been declared a recession by the NBER. I don't think the Fed chair needs to get into using that language, but essentially they're engineering what we used to call a growth recession at minimum. And I think you're right. I think you have the transcripts available, but I do think earlier in the year when he got similar questions, he would talk about the hope for I think I used to call it a softish landing, and I think we got less of that today.
It's the reality of it all, Rich. Finally talking about the pain that we need to go through, and that really started, Tom, with the Jackson Hole speech, I think, in a more profound way.
Yeah, and John, you've been on this where you've carried forward the idea that it's a continuation of Jackson Hole. There's a group of people, arch-qualified, people that have done work like you. I'm going to pick on David Blanchflower up at Dartmouth with work at Bank of England, and of course his classic, The Wage Curve, who say, look, we're conflating here the financialization or the monetary policy solutions to our post-pandemic challenges with just public policy of saying it's okay to recover and to be calmer about inflation and not try to get to this Taylor-like rule of 2%, but move it higher. Adam Posen says 3%, Blanchard stocked post-crisis of 4% with Stiglitz. Why are we wedded to 2.0% is the bogey?
The short answer is New Zealand. So New Zealand was the first country to formally target inflation, and they picked the number 2. And it's only half in jest. There was nothing magic about 2 versus 2.5 or 3. Where I do think this could end up in a couple of years is the Fed does get inflation down into the 2s. Call it the 2 point something.
Top line inflation.
PCE inflation, but headline PCE inflation is in the 2s. And in that environment, I could well see the Fed on an extended pause or perhaps even beginning some modest cuts and not really doing the heavy lifting that their models will say they would need to do to bring it down from 2.8 to 2. And then that will tee up the next review of the Fed's framework, which the chair has indicated will commence in 2024 and complete in 2025. And the Fed could well, in that review, consider raising the inflation target. Now, interestingly enough, the chair was asked that specific question in the spring. Would you support raising the inflation target to 3? And he gave a 2-letter answer, no. So
that is the codification of that's the entrenched institutional mantra right now. Explain to me the ramification to our viewers and listeners of moving from 2.0 to 2.1. Hedge it down. Make Adam Posen angry. 2.8% and not 3. What would happen to us?
Well, it would be path dependent depending on how we got there. But under a lot of scenarios, very little would happen. I mean, the 2.5 would become the new normal in economic recoveries and expansions. And if you had a recession, it would dip down below that. So I think it depends on how you get there. Maybe a little context is useful. So when I participated in the review that we did in 2019 and 2020, we actually took raising the inflation target off the table. And the reason why we did so is, we felt it would be difficult to get consensus on the committee at that time, since the challenge historically for the Fed inflation had been below 2%. So we thought you don't really solve that problem by declaring 3 or 4. But the circumstances under which the next review will be undertaken will be different. So they could consider that.
Don't you think it would be harder to anchor inflation expectations if you start to wobble under existing mandate?
Well, and that will be the pushback, certainly. But I'm merely saying that this is something, especially the committee is a different composition than it did than the committee on which I served. And so it's certainly something that could be on the table.
Already getting some upgrades to forecast. This from Mike Gapon at Bank of America moments ago. We now expect hikes of 75 basis points in November, 50 basis points in December, followed by 2 25 basis point rate hikes by March of next year. They go on to say our new terminal target range is 4.75 to 5%, up from 4 to 4.25%. Previously, it's amazing to me and everyone else, and Lisa, you included, just how much this has changed and how quickly it's changed. In the last week, I think it was just last week, 1 week ago, Matt Lazzetti of Deutsche Bank came out and said, I think Fed funds close to 5. Sounded like an interesting number at the time, maybe a little bit of an outlier. Market was at 4.5. Everybody's gravitating towards that kind of world.
And it's kind of amazing, given that we haven't seen more of a disruption. We are seeing now markets reverse, stocks now down. We are seeing yields higher. You look like, okay, finally, they're sort of hearing the message,
I'm sitting there thinking you're going to be busy if you keep trying to do this, because we were up, we were down.
I know. We're whipsawing around as we try to understand the ramifications. When do you expect to really, Rich, feel the pain? Right, to start seeing the unemployment rate rise. And I say this, as Neil Dutta put out there on Twitter, the faster the unemployment rate rises, the better for risk assets in this perverse way, because the closer to the Fed's goal.
Well, the Fed goal ultimately, though, is to bring down inflation. And so the real wild card in this is the first step is slowing demand, so you see the rise in unemployment. The second is how quickly does that translate into declines in inflation. And so I think there are a lot of steps along the way. I take the chair at his word. I think they want compelling evidence, and I think that unfortunately it's going to require compelling evidence of pain not only in economic growth but in the labor market. And I think that, as I said, the pre-pandemic Fed had the luxury of being very nimble with regards to adjusting rates to unemployment, and I just don't think that they think they have that option, at least for the next year.
And Mike, it's the hawk on repeat at the moment, Mike McKee. That line he used, it will be enough, we will keep at it until the job is done.
Yeah, and that raises the question of how much faith we should put in these projections of the dot plot. And I will ask Rich, because he participated in this. When you look at 4.4% next year, you have to round that up. They're really saying 4.5 because of the effective rate. And you had 6 people at 4.4, and you have 6 people at almost 5. They're pretty evenly divided. What are the chances that, let me put it this way, are the chances greater that we go to 5 than we go under 4.4?
I think so, because I just think that's the initial conditions on inflation and on the economy. And so, yes, I don't think it's an even bet there. I think the skew is going to be hawkish. And I think, President Bullard and others have made this point, Jim, more directly than some others. I do think that now the view is, now what we're seeing is that they have a sense of where they want to end up, not precisely, and they want to front load as much as they can for a variety of reasons, including the fact that doing this now is more straightforward to pull off when the labor market is still printing 300,000 jobs and the unemployment rate is still low, and the cost of delay could be very substantial. So I do think that you do have a broad sense of getting this done, getting where they think they need to get by early next year.
They've done a lot already. 3 percentage points of hiking in 6 months.
Yeah.
Didn't even do this in 3 years the last time around. If you are just tuning in on TV and radio, reacting to the Fed decision and Chairman Powell news conference, this is Bloomberg Surveillance, a special where Lisa, Tom and I stay a little bit later. Some of you are happy with that. I'm sure some of you aren't, but tough. Your equity market is down by about 0.9% on the S&P 500. On the NASDAQ, we're down about 0.85%. Lisa and I were talking about this. This equity market has been all over the place. If you're looking at the bond market, at the front end, yields were much higher. They're up by 7 basis points now, 4.03%. It's a 75 basis point hike, and we've gone through the forecast a few times. I can do it again for you without just giving you all the numbers. The GDP forecast revised lower for 2022, for 2023, likewise for 2024. The unemployment rate kicked higher, and the dot plot kicked higher in a material way as well, off the back of, let's just say, a more constructive inflation forecast relative to the aspiration maybe of a few months ago. Do you want to let me finish just quickly?
Go ahead, Gary, carry on.
Fed funds and where they think it's going to be. I'll squeeze that in. 4.6% for 2023. 2022, they've got it at 4.4%.
Can I just say, why is it that the market thinks that this is more dovish than raising rates by 100 basis points and then 50 basis points the next meeting, which is basically what's being priced in?
I've got no idea.
That's all I want to ask.
I'm not sure if it's even dovish right now, though. I mean, what are we down? We're down by 1% there and thereabouts. Yields up at the front end. If it stays here. Once again, we did this the last time the Fed met. I don't think you can define, Tom, any given meeting by the intraday price action on the S&P 500.
I strongly support that.
The Chairman Powell was
back and forth.
It's unanimous.
Chairman Powell was pretty clear, Rich, and I think we can all agree. This is a guy who wants to get things to a sufficiently restrictive stance. Things are a ways away from there at the moment, so they've got more work to do. And once they get there, they want to keep it there. They want to maintain that stance and have clear evidence that inflation is on its way back down to 2%. And that sounds like a story for the end of 2023. Never mind the end of 2022.
Very quickly here, John, as we get to Jeff Rosenberg with BlackRock, across the arch of our debt, which is a price, which is yield, the twos as compared to the 30-year bond, the 2-year note compared to the 30-year bond is to new substantial inversion of a negative 55 basis points.
Down 12 basis points, just today, by the way.
This speaks volumes. We can get interpretation of that as Richard Clarida stays with us. With Jeffrey Rosenberg, he's Senior Portfolio Manager at BlackRock. Jeff Rosenberg, what does the different spreads in full faith and credit tell us now? The 2s10 spread, negative 53 basis points, and the 2s30 is unspeakable. What do they say to us?
Well, the big thing they say to us is that a lot of what we just heard is reflected in that front end of the curve. You know, we saw a 50 basis point increase effectively from the release of the the August CPI earlier this month. And effectively, the Fed raised 50 basis points in terms of how much they were going to increase their tightening. And that's fully reflected now in the front end of the curve. So you're getting a lot of the kind of expected path. That was what was new today. What was new was a little bit higher, a little bit more front loaded. What's the same story is the Fed doesn't have to do very much to the economy, to unemployment, to get a spectacular decline in inflation. So that story is the same. The other thing here, Tom, is TIA. There is an alternative. And that's the front end in yields. You know, they reflect most of what the Fed is expected to do. If that forecast is correct here, a lot of the pain in terms of bonds is behind us, and so that gives investors a real alternative.
Jeff Rosenberg, you were weaned at Carnegie Mellon with Alan Meltzer, Marvin Goodfriend, and all, and the mathematics of Carnegie Mellon. Off the back end of every equation is a Greek symbol, epsilon, which is the uncertainty that's out there. How uncertain is your fixed income investment path forward?
Yeah, that's what I was referring to in terms of what's not new here is this essential implicit consensus view on the ability of inflation with this amount of policy restriction to have a spectacular decline. And he got the question on that inflationary forecast, and he kind of outlined, you know, what needs to happen in order for that inflation decline to occur. But that is the essence of the uncertainty here, Tom. And what's remarkable is we keep getting that wrong. We keep being surprised at how durable inflation is, yet our expectations and what's priced into markets, what's priced into that back end of the curve, to your first question, is a very strong view that inflation will come down along that path, and therefore you don't need a big inflation risk premium. That's the uncertainty. That uncertainty is not being resolved here today from the
I'd throw in another thing we're getting wrong as well, Jeff. We're getting that wrong, and we're also getting wrong this idea that we can test the Fed's resolve and have this idea of a pivot every 6 weeks or so. What did you make of the nod to Draghi? I pulled up the speech from July 2020 to 2012, and it wasn't just the whatever it takes. It was the final line Draghi used after that, and believe me, it will be enough. And then Chairman Powell, it will be enough. Jeff, what did you make of that?
Yeah, you know, it's a very different context. And in some sense, I think, you know, there's a real question here about whether or not that is right, whether this will be enough, because, you know, there is a whole other viewpoint out there. You know, it's Summers, it's Jason Furman, it's other folks, you know, talking about how this is still somewhat very unrealistic economic projections coming from the FOMC. When you look at those SEP projections, that another view of the strength in the labor market suggests that you need to have much more restrictive policy for much longer. So it will be enough is probably not the conclusion I think a lot of folks would draw, given the strength of the labor market and the resilience in the economy to you know, obviously it's a lag here and we haven't had enough tightening. But it also points to the potential that there may need to be a lot more in terms of policy. That's clearly not in market expectations, nor in the Fed's forecasts. So that's the other side.
Well, Rich, you noted that. You actually raised your eyebrows when we heard that from Fed Chair Jay Powell. It will be enough. What was the significance of that to you?
Well, I want to go back and look at the transcript, but as I recall, the way he answered the question was to discuss whether or not the dots would be enough that were showing the rate hikes penciled in. And I heard him to say, but again, I want to look at the transcript, but right now, don't look at the dots. I'm telling you what we will do will be enough. Not that the dots will be enough, but what we will do will be enough. And so in that sense, I think it was maybe closer to the Draghi-esque unconditional commitment, not to any particular destination for rates, but to succeeding and as Paul Volcker said, to keep at it till the job is done.
So, Jeff, from your perspective, how far away is the market from realizing this conviction of Fed Chair Jay Powell today that he will do what it takes?
Well, Well, I think with respect to the expectation that inflation will fall and will fall quite dramatically with what is priced into that dot plot to those median estimates, the market is there. But it's important to remember that the FOMC's projections can be wrong. The market can be wrong. So we are pricing in a consensus view and a path for inflation that is basically at the end of 23 back down to pre-COVID 2% levels with a 4.4% peak unemployment rate. So if that indeed turns out to be the case, then the market is reflecting those expectations. But there is, the possibility, and to Tom's question, I think a lot more uncertainty should be expected around that outcome actually being realized.
Hey, Jeff, thanks for completing just a fantastic lineup for us on Fed Decision Day. We appreciate it, sir. Jeff Rosenberg there of BlackRock. A final thought now with Rich Clarida. Rich, I saw a tweet a little bit earlier as this news conference was going, and it said, you want the bad news? The quiet period's over. The Fed speakers are going to start coming out now. Can you tell me, as someone who was on the board, when you see the regional Fed presidents starting to muddy the message a little bit, how does one feel on the committee when that starts to happen?
Well, I mean, I be very diplomatic. I had regard and respect for all of my colleagues and learned a lot from them. I think this is the world. ECB is the same way. You can't put the genie back in the bottle where there's the one voice. And so I think it's fun. As I tried to mention a moment ago, so far the Fed has pulled off a remarkable hawkish pivot because the chair has been willing to own the guidance. Where we get into tricky territory will be if the chair steps back from owning the guidance, and then you've got 18 different opinions about the destination for rates. But right now, this is not only is it Jay Powell's Fed as chair, but he is owning this message and using every press conference and every speech to hone the message.
One of the great pieces is Ken Rogoff's tribute to Rudy Dornbush at the IMF a million years ago. It is just a superb exercise in a tragic early death. The fact of the matter is, right now, pound sterling is having a tragic and early death. Tomorrow, the governor of the Bank of England has to staunch sterling 112.89. Forget about John Connolly. I'm suggesting that's Jerome Powell's problem.
Well, because it's not just the UK. There are probably 40 or 50 other exchange rates that are moving by similar amounts in similar directions. I think, as I alluded to in the earlier segment, what can go wrong? Well, obviously a lot of things can go wrong, but it may not be the U.S. financial system. It may be collateral damage globally in a strong dollar period. And then you, of course, on top of this, you have whatever the heck is going to happen in Ukraine and China. There's enough going on right now.
You free at 6 a.m. tomorrow?
Well, it depends.
You could just say
That's what I say, and it never works.
Rich, this was awesome. Thank you, sir.
Well, what's your calendar look like November 2nd?
Yeah. Consider it done. No, it's been too long, folks, and so
we'll make it happen.
Tom Keene Booker.
There we go.
It's a new job.
Career TK. Richard Clarida there, the former Fed Vice Chair, and so much more. Thank you, sir. We appreciate it. Counting it down to the close now. We're down about 1 full percentage point on the S&P 500. I'm pleased to say Romain and the team will do just that. Romain joined us now. Hey, Romain.
Hey, yeah, we're going to be pushing ahead, of course, to Bank of England, the Bank of Japan, and, of course, the Swiss National Bank. The last in Europe still clinging to negative rates. Jason England over at Janice Henderson going to be stopping by the close to give us that global view. We're also going to be talking to Rob Waldner over at Invesco, the chief of fixed income strategy there, to talk the bond market reaction. Of course, another volatile day in Treasury markets, in the FX markets, and, of course, in equity markets itself. We'll break it all down for you in just a couple of minutes here when we count you down to the close.
Thank you, buddy. Looking forward to it. Romain and the team are going to do just that in the next couple of minutes. Bramo, we're down on the S&P 500 by 1.3%. This one's been hard to keep up with, hasn't it, today?
Yeah. Steve Chivarone wrote over at Federated. He tweeted at me, the market once again tried to indulge dovish fantasies by latching onto any miscommunication for Powell, but for the first time, he did not provide red meat.
There we go. For how long?
Well, let's see. Let's wait 20 minutes.
I mean, let's see. Tom, tomorrow. I think you put it right. That's the next step now. It's the Bank of England's turn. It's the SMB's turn. And they're looking at an FX market, which is tricky.
Dr. Clarida alluded to this twice. This is an international Federal Reserve. They can job on the domestic, including you mentioned the senator from Massachusetts. Guess what? It's about the Philippines. It's about Thailand. It's about the United Kingdom.
But what are you doing at 6 a.m. tomorrow?
I thought I'd drop by. Looking forward to this. Yeah.
Might see you there. Lisa, fancy it?
I'll see.
All right,
I'll
okay.
see if I find.
We will all consider whether we're with you.
We'll
6
consider
a.m.
if we're still
tomorrow.
on speaking terms.
From New York, thank you for being with us. What a fantastic lineup for all of us. Live from New York City, this is Bloomberg.
From Bloomberg World Headquarters, I'm Charlie Pellet. Lows of the day for the U.S. equity market. 14 minutes to go on a Fed Wednesday. Right to the numbers. We'll give you the why in a moment, with the S&P now down 56 at 37.99, taking out 3,800. Right now, we have got the S&P down 1.5%. The selling for the Dow continues, down 433 right now, down 1.4%. NASDAQ down 171, a drop there of 1.5%. The two-year yield, 4.03%. Worth repeating, 4.03 on the 2-year. 10-year yield right now, 3.52%. Spot gold up 0.5%, 16.73 the ounce. Bitcoin up 0.6%, 19,081. While West Texas Intermediate crude is down 0.6%, 83.40 for a barrel of WTI. You heard it live right here on Bloomberg Radio. Fed Chair Jay Powell vowing officials will crush inflation after they raised rates by 75 basis points for a third straight time and signaled even more aggressive hikes ahead than investors had expected.
My main message has not changed at all since Jackson Hole. The FOMC is strongly resolved to bring inflation down to 2%, and we will keep at it until the job is done.
Again, a 75 basis point move today. The 2-year yield, 4.04%. 10-year yield, 3.52%. The Dow, the S&P, NASDAQ, all at the worst level of the day right now. Recapping, S&P down 54, a drop of 1.4%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, you are listening to Bloomberg Business Week. We've got just about 12 minutes left in today's trading session. We got the Fed decision as expected, but a hawkish 75 basis points is how many are talking about the latest move by the Federal Reserve, raising interest rates by 75 basis points. We've seen markets certainly bouncing around on a day when we already saw the 2-year hit an interesting point above that 4%. Right now, we've got stocks at their lows of the session. So let's get to it. Let's talk about the Fed decision and the trade.
We got Anna Hahn with us. She's equity strategist for Wells Fargo Securities. She joins us on the phone from here in New York City. Anna, help us make sense of these moves today. We're going to talk about bonds in just a second, but the equity market going from highs to lows to highs and now back at lows. What's going on here?
Yeah, it's a little bit of a pogo stick at the end of the day here, and you saw that pretty strong sell-off coming into the close. I think the main driver in the knee-jerk reaction was that the Fed left the door open for a 75 basis point hike next meeting. The 75 basis point hike this time was consensus, but leaving that open and perhaps the hint that we might be able to tolerate a higher employment rate with the change in the Fed's expectations for the employment rate and economic growth. All this combined seemed to signal hawkish for longer, and equities knee-jerk reaction was down. But I don't think that's the full picture. I think we got to think longer term here.
Well, and let's talk longer term, because that dot plot, scatter platter, as I like to describe it, really was a scatter platter when it comes to longer term projections, when it comes to rates here. We've also heard earlier on Bloomberg Surveillance, Bloomberg TV, our surveillance team talking with Diane Swank, saying that, she thinks it's going to be hard for the Fed and its growth projections for the U.S. economy, that they seem too optimistic. She says that housing market's already in a recession at this point. Anna, how do you see it? Do you think the Fed's projections are on the money or not?
Oh, well, it's hard to say if they're going to be really on the dot, but I think it's more the directional move that we have to consider here. I do think that we expected economic growth needed to move lower, and you bring up a great point. The consumer can tolerate inflation and also the tightening monetary policy and balance that with their spending to keep economic growth continuing.
I did find that to be a really interesting moment of Fed Chair Powell's press conference. Was, when he went through all the economic indicators and talked about softening demand, and he talked about CapEx spending going down, he talked about the growth of the consumer had slowed, but then he said there is that pesky labor market, and it is just too strong. Weaker economic growth abroad is constraining exports, but again, that pesky housing market. Pesky labor market. When does that labor market start to show weakness?
Well, timing-wise, I'm not sure when the labor market is really going to perhaps contract aggressively, but what we are seeing is that hiring is starting to cool in some sectors, but it remains hot in others. And this is the difficulty that the Fed is having, where we're trying to cool one part of the market, but also toe the line without pushing it into a deep recession. At the same time, you're seeing this increase in recovery in the services part, and yet the durable goods part of the market maintains really firm. So I think when you start seeing cooling in more of the durable parts of the market, that's also going to help bring a little bit of the labor market more into correction. But also keep in mind where we are on the unemployment rate. It's still historically low. So seeing it move up to, 4.4% at 2023, it is higher, but it's not necessarily recession levels.
Anna, one thing we know, the Fed and our Lisa Abramowitz, so smart earlier with the surveillance team saying, talking about this hawkish Fed, 75 basis point hawkish move, and that this is proof, and including the commentary we got from Jay Powell, that the Fed is willing to allow the economy to take on some pain as it continues to raise rates to try and bring down inflation. Is that fair in your view?
I think so, and that's what you saw when the Fed lowered their economic growth estimates and they raised their unemployment rate estimates, all the while leaving the door open for that next 75 basis point hike. So combined, that message is showing you that they're willing to maintain a hawkish path to fight inflation, which has been persistent and peskily high. To bring that inflation down, they're willing to tolerate a little more pain. And again, part of that might be because, like you mentioned, the strength we've seen in the labor market. And until corporates realize or get to the point where they cannot afford to bring more workers on board, or they cannot afford to pay that price, or perhaps demand for their products cools so that they don't need as much labor, that's really when we're going to start seeing more of a correction.
Hey, Anna, one thing I think is interesting, we've heard from a couple of the big bank CEOs, they were up on Capitol Hill, but with some negative words about the outlook and questions about the U.S. outlook. Do you feel like the next earnings season, which I feel like becomes our next focal point, is going to be a shocker and a negative one?
I have to say our base case right now is that this upcoming earnings season won't be a doomsday scenario. I think that you're going to hear from corporates a similar tone of what we heard in the last several quarters, which is inflation is eating at our margins, but we are finding a way to mitigate it so far. Also, now you have to introduce the currency volatility and the change in consumers' risk appetite, or where they're spending, really. So putting it all together, I think you're going to hear from banks and corporates earnings season that things are getting a little tougher. People are starting to feel the weight of the recession a bit more, but it's not this complete contraction and sapping of power consumer spending, and that should help keep earnings afloat through the end of this year. So hopefully that catalyst can be one of the positives for the equity market going into year end.
I'm still just puzzled by today's equity market moves. I don't get it.
You're puzzled because trying to cross Lexington was just a bear because of the UN General Assembly and the president. We actually saw the president.
We got to see President Biden just now.
We found the beast, right?
Can you hear us breathing rapidly because we ran here and got stuck on Lexington Avenue? But truly, by the time we left the Plaza Hotel, 15 minutes ago, 20 minutes ago, stocks were higher. We come back here, we're at the lows of the day. I don't get it.
Yep, and what's even more interesting is as you're seeing this aggressive sell-off in the last, 30, maybe 45 minutes of the day, actually the 10-year yield had dropped lower in that time as well, and it was also kind of hopping around. I think the end-of-day sell-off and this volatility in one day is showing you that markets are trying to reposition for what could be continued monetary tightening, but also keep in mind, if we are addressing inflation more aggressively, we're also hoping to bring it down quicker. And there could be aspects of that our people are considering as well. And also what I like to point out is that terminal rate being raised to 4.4% this year, 4.6% in 2023. That's still pretty close to where markets had been pricing it before the Fed announcement today. So putting it together, there are some unexpected portions, but I think the equity sell-off is more people shying away, getting a little more risk averse, and taking a minute with pencils down to think about how you want to position for the rest of the year.
Yeah, it is interesting to, one of the things I want to talk about with our TV colleagues coming up on Beyond the Bell is what we saw in the VIX this year, and it did pop up to, today. VIX actually hitting 30, so popping up about 3 points earlier in the session. I mean, volatility, we know, people have talked about, we've really got to see it move much higher to see some true market capitulation. On the Treasury trade, just 20 seconds left here. Do you feel like 4% is it in terms of topping out for the 2-year yield, or, based on what we got from the Fed, it could go a little bit higher?
I do think that for the rest of this year, our terminal rate would be a bit higher, and the 2-year yield tends to be pretty close to that. So I do think you could see some more upside. But with that said, when we think about further out on the curve, maybe more the 10-year and how that might impact equity growth investing style,
right?
I think you actually could see a little softness there if the Fed is able to front load their hikes, and that could help the GARP trade.
Always good to check in with you. Anna Hahn, she is equity strategist over at Wells Fargo Securities on the phone in New York City. Just a few minutes left in today's trading session. Right now, we want to head over to our TV team for Beyond the Bell, live on radio, TV, and YouTube. We are counting you down to the close on this Fed Wednesday.
Well, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Caroline Hyde, Taylor Riggs counting you down to the closing bell. Here to help take us beyond the bell. It's a global simulcast with Carol Master and Tim Stenovic. We welcome our audiences across Bloomberg Television, radio, and YouTube to parse the most crucial moments of the day. One of those crucial moments, of course, came during the press conference. Jay Powell, Carol, saying we have to get inflation behind us. I wish there were a painless way to do that. There isn't.
Yeah, I thought Lisa Abramowitz, part of our surveillance team, really hit it right, that the Fed is showing, Jay Powell and company are showing that they will do whatever they have to do, and that means whatever economic pain they have to cause in order to get inflation down. There is it, folks. If you're looking for a message from the Fed, as Romaine said, that's it.
But I'm a little puzzled by the equity trade today and why we didn't see stocks move lower until after the Fed chair was done speaking. I mean, what happened in the last 30 minutes that caused this sell-off? And we saw a sell-off right at 2 p.m., but then stocks climbed after the Fed chair started speaking and people started going through those minutes. What happened in the last 30 minutes?
I think Richard Claridis said it best. Talk to me tomorrow once the equity market has had some time to settle, Caroline. Way too much going into sort of the intraday moves of what's going on. We talk about the lows of the session. Let's talk about tomorrow when we sort of settle out here. I really like some of the comments when we're thinking about a terminal rate, a lot higher than where we thought that terminal rate was, Caroline, going back in June.
Or maybe it is the post-match analysis that starts to change the tune. Maybe it is as Seema Shah over at Principal Global Investors who says soft landing is now almost off the question. Former Fed Governor Larry Mayer, of course, all outlined by our top live blog here at Bloomberg. We're raising the terminal rate on our baseline to 5 to 5.25%. Maybe that's what sends shivers.
Well, the summary of economic projections has us at 4.4% by the end of this year, 4.6% in 2023. But more importantly, looking out to 2024 and 2025, still looking like they might hold close to 3%. Elevated for a long period of time here, and the market has to adjust to that. The Dow Jones Industrial Average finishing the day down by more than 500 points or 1.7%. The S&P 500 down 1.7%. The NASDAQ Composite down 1.8%, and the Russell 2000 going to finish the day down by about 1.4%.
All right, just taking a quick look at the VIX, and we did see the VIX actually hit 30 earlier in the session, so significant moves there. Ending up the day just shy of 1 point, though, Taylor at 28.14.
Carol, I love when we do this, when we talk about sort of the major indices and then dive down deeper underneath the surface for the radio audience, the sector winners and the sector losers. And it is red all across the screen as you're really trying to digest again sort of what hawkishness from this Federal Reserve looks like. One sector in the green, food and beverage index, of course, you're up about 0.2%, maybe some of those classic inflationary hedges. Otherwise, really, Carol, everything down in the red. I'll take you to the bottoms, sort of classic long duration assets as yields are rising again. It's media, it's banks, it's auto components, telecoms. Those sectors are off 2 to 3% on the day.
All right, let's get to some of the specific gainers. Of course, a lot of bouncing around in them as well, but certainly a standout clearly. General Mills, top in the S&P 500, ticker GIS, up as much as 7.5% in today's session earlier on, finishing with almost a 6% gain. They came out with earnings. They raised their profit and sales forecast for the year, talking about strength in the fiscal first quarter results, stronger than anticipated quarterly adjusted gross margin results. This stock doing pretty well this year. It's up about 20%. All right, Illumina, also a standout in both the S&P 500 and the NASDAQ 100. It was up about 1.8%. The only news I came across from, and this is certainly significant, the European Commission earlier in September prohibiting the acquisition of Grail by Illumina, but it looks like it was made public. So again, saying no to a deal. Maybe investors are happy that they're not doing. And just want to mention e.l.f. Beauty. It was up as much as 4.5% earlier in the day. Morgan Stanley raising its price target on the stock to 46 from 42, still finishing the day with a gain of just about 0.75%, so off its highs, Tim. The stock closing at $39, almost $40.
All right, well, as we just heard from Taylor, consumer discretionary, the worst performing sector in the S&P 500 today. The S&P closing down to its lowest level since July. The NASDAQ 100 falling to its lowest since July 1st.
Is that why you're wearing a tie today, a solemn occasion?
It's Fed Day.
Yeah.
I thought I would dress up.
Are you like the contrarian indicator?
This is my...
If Tim Stenovic is wearing a tie, you know to run for the hills.
I mean, who knows with what happened with today's trade? But I do know that Amazon really weighing on both the S&P 500 and the NASDAQ, finishing down more than close to 3%. Marriott also down 5.6% today. Can I say 3%? All right, we'll go ahead and say that. That's 3%. But speaking of Marriott, those travel exposed stocks, we're talking airlines, cruise operators, hotels. Yeah, they got hit hard today. Rising geopolitical tensions. We got the news out of Russia that President Vladimir Putin calling up more troops in a major escalation of his invasion of Ukraine. So sent some concern throughout the sector. And then also Visa finished knitted down by 2.6% today.
Just real quickly, before we move on, we should point out that all those big tech names, with maybe the exception of Amazon, are all at either 52-week lows or their lowest in a couple of years. That includes Alphabet, Microsoft, Micron, and of course, we know Meta, which has been down in that hole for quite some time.
And there was that Meta news as well earlier today, Romaine, about the company slowing down when it came to hiring, and then looking to to bring in costs as well. Not necessarily laying people off, but doing this through attrition.
Yeah.
And I want to go back to, Tim, what you were rightly talking about as the big pre-Fed game. We're all talking about that geopolitical risk dialing up a little bit. And we saw, of course, the movement into the dollar, into the euro, but that faded as really it just became a dollar story once again. We go cross asset. I look at an FX board that shows weakness across the entire FX spectrum in terms of G10 currencies versus the US dollar. King dollar is back as we look at a more hawkish Federal Reserve, as we look at 75 basis point hikes yet to come. Danish krone off by 1.3%, the euro weakening by 1.3%. Important to keep an eye on the British pound because it is the Bank of England that comes up tomorrow. Bank of England weakening by 0.9% in terms of the great British pound. And indeed, we see, of course, the Bank of Japan that's in the line of fire. We think about what they do on Friday. Of course, they were busy buying up their bonds. We saw that overall the Japanese yields sort of are moved by the fact that the Japanese have been spending about $9 billion trying to buy up their debt to steady some of those yield moves. We see commodities market that is, again, worrying more about a slowdown, a global slowdown, than it is perhaps that geopolitical tension. In the oil market, WTI crude actually falls 0.8%, even though we get that rhetoric coming from President Putin. Brent crude down by some 0.6%. And the bond market, I referenced the Japanese bond market a little bit, but a mixed bag, really, maybe a flight to safety in Europe happening with German yields and indeed Dutch yields coming down a little bit, Taylor.
We see similar story, Caroline, on the long end of the yield curve here. Today, it is a story of inversion, the most inverted on 2s10s. I do this for Romaine since April of 2000. As yields are up 8 basis points on the 2-year, finally getting back above 4%, some of the first times we've even seen that since about 2007. And again, 8 basis points lower in yield on the 30-year yield as we think about that further inversion, peak hawkishness on the front end, and lower growth, lower inflation expectations on the horizon. Of course, we're hearing a lot about that given today, given the comments from Jay Powell. Take a listen to some of his key takeaways.
My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, bringing the target range to 3 to 3.25%. And there will very likely be some softening of labor market conditions. What we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%. We've just moved, I think, probably into the very lowest level of what might be restrictive. We probably in the housing market have to go through a correction. The median for the year end suggests another 125 basis points in rate increases.
And Carol, I really wonder if this is what the market is picking up on, a higher terminal rate than we thought. Definitely no cutting in 2023 as we're looking at maybe another hike, of course, then. But really hinting about some of that lower growth and lower inflation on the horizon that is going to be necessary to get inflation under control.
Right. The Fed is, showing that it's willing to do that, although he didn't, I don't know how many times, or did he even use the word recession, and just got kind of close to it. So I do wonder about that.
Might be key trying to push in that.
Yeah, exactly, right?
Yeah,
we didn't quite get there, did we?
Well, he did address it. I mean, and this is his quote. He says, no one knows whether this process will lead to a recession or how significant that recession will be. So that's 2 uses of the word recession. He didn't actually answer the question, but he did mention it, and I think it's the elephant in the room. And I thought the idea that he sort of walked back the idea of a soft landing, at least in a way that only the Fed can sort of walk something back. But the idea that he seems to now be sort of factoring in the possibility that we are in for some real economic pain, but he seems to be okay with that as long as the objective of pulling down inflation is achieved.
One part of his press conference today that really stuck out to me was when he talked about all the different economic indicators that we talk about each and every day, showing that the economy has slowed, right? The growth of consumer spending has slowed. Activity in the housing sector has weakened significantly. Weaker economic growth abroad has constrained exports. But then there's the labor market, and it continues to be out of balance. He said the labor force participation rate showed a welcome uptick in August, but he still sees that imbalance between the number of jobs available and the number of people who are going out to look for them. And I wonder, how long is it going to take for the lowest level of a restrictive rate to start to go through to the labor market, so we're not seeing hundreds of thousands of new jobs added to the economy every month?
Well, already we're hearing the rhetoric coming from companies, whether it be just in the micro, but drip, 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 we get company after company slowing hiring or indeed starting to do layoffs. At what point does that start to filter into some of the economic data that we look at? But certainly it does feel that the sentiment from the CEO perspective has shifted.
Yeah, and interesting to see that ultimately we ended with equity lows, but we also saw the yields kind of back off their highs. So interesting to see that trade dynamic, and that's how we closed up on this
highs are the
Wednesday.
intraday. But just real quickly to Powell's point on the recession, he did say that if he can get inflation down, that in and of itself could help us avoid a recession.
If and buts or candy nuts, we'd all have fun.
Well, that's all we got with the Fed.
That's all we got. That's all we got. All right, guys, that's a wrap for our cross-platform coverage on radio, TV, and YouTube. Beyond the Bell on a very busy Fed Wednesday. We will see you same time, same place tomorrow.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, you are listening and watching Bloomberg Business Week on radio, on YouTube. And yeah, this is a big deal. Obviously, feels like a very aggressive Fed. Let's see what the CEOs have to say when they start to report earnings.
Yeah, everyone's got to digest this stuff. We'll see what happens tomorrow. In the meantime, let's get to world and national news with Nancy Lyons in D.C. Hey, Nance.
Thanks, Tim. Harsh words for Russia today from President Biden, who addressed the UN General Assembly.
This war is about extinguishing Ukraine's right to exist as a state, plain and simple, and Ukraine's right to exist as a people. Whoever you are, wherever you live, whatever you believe, that should make your blood run cold.
Biden said if nations can pursue their imperial ambitions without consequences, the UN puts at risk everything it stands for. Biden spoke hours after Russian President Vladimir Putin called up 300,000 reservists and what he labeled to be a partial mobilization effort. The news sent thousands hurrying to the border to Finland and prompted Putin to ban all Russian men between the ages of 18 and 35 from boarding any flights out of the country. Donald Trump is being sued by the state of New York for allegedly using fraudulent asset valuations at his real estate company. Attorney General Letitia James filed the suit today, the culmination of a years-long probe into dealings by the former president and his family.
Claiming you have money that you do not have does not amount to the art of the deal. It's the art of the steal.
James says 3 of Trump's adult children are also named in the lawsuit. She believes Trump also violated federal laws, and she's referring those alleged criminal violations to federal authorities, including the IRS. Trump on his Truth Social platform calls the lawsuit another witch hunt. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nan, thank you so much. Carol Massar, Tim Stenovic. We are back in our Bloomberg Interactive Broker studio, streaming on YouTube. We say back because we've been over at the Plaza at the Earthshot
Prize Innovation
Prize
Summit.
Innovation Summit, a whole day event, and it's all about looking at the climate change, the innovators, the people involved in creating, initiatives, businesses, programs, strategies to combat climate change. And it was a really interesting juxtaposition. You and I we were racing back against, Fed decision, things that obviously are front and center, important to the markets, important to the economy, against, these people who are working on initiatives to basically save the planet.
Yeah, it was really remarkable stuff. And you might have caught the first half hour of kind of our special program. It started at 1 p.m. Wall Street time. But we spoke to Hannah Jones. Actually, you spoke to her earlier in the day, the CEO of the Earthshot Prize. And then we heard from Dr. Andrew Forrest, the executive chairman over at Fortescue, who talked about this huge investment, more than $6 billion that he's making into his iron ore mines to curb emissions, moving completely away from fossil fuels.
Right.
But you had some big stuff this morning, too. I mean, you were there all day.
Well, yeah, it was interesting just to kind of listen to all of the conversation. Mark Carney's there, of course. Matt Damon was there. Sam Waterston. I mean, these are
Gavin Newsom was there.
People who are, various initiatives, specific organizations, and just interesting to hear this dialogue. And I do feel like there is a consensus or growing consensus that some of these targets that have been, put out there to be net zero or carbon neutral or what have you, it's just they're too far off, and that we've got to make changes now. I had one of the Earthshots winners from the first year, 2021 inaugural, who is basically growing reefs. It's unbelievable, growing reefs, and saying that about 90% of the reefs have been wiped out.
By the way, all of this happening during a time when the UN General Assembly is in session. So everywhere you turn, there's some sort of head of state or diplomat. And on our way back, we were kind of stuck because President Biden and his motorcade were going north.
Yeah, it's a busy day here in New York City. All right, guys, lots more to come right here on Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Bloomberg World Headquarters, I'm Charlie Pellet. Fed Wednesday, wild day for the U.S. stock market. Some crazy gyrations. Traders overwhelmed by the many headlines following the Fed decision and Fed Chair Jay Powell's press conference that ended up signaling at least two things. Policy will remain aggressively tight, and the odds of a soft landing look increasingly elusive. Let's begin with that 2-year above 4%, 4.03% right now on the 2-year. We've got the 10-year, 3.51%. Equities not only moved lower, but closed at the worst level of the day. Today, the S&P down 66 again. It was a wild session, but it fell 1.7%. The Dow down 522, also down 1.7%. The Nasdaq Composite Index down 204, a decline there of 1.8%. Spot gold up $8 the ounce to $16.73, up 0.5%. West Texas Intermediate crude down 1%, 83.12 a barrel. Bitcoin now little changed at 18,959, down by 0.2%. KB Home, after hours, down 4%. The home builder reported deliveries for the third quarter that missed the average analyst estimate. Recapping, a move lower with the Dow, the S&P, and Nasdaq all declining by at least 1.7%. 2-year yield, 4.03%. 10-year yield, 3.51%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. After a day full of Fed talk, and rightfully so, and of course a Fed decision, we thought we wanted to bring you something a little bit different. And it's got a great headline on it. Wanted salesman for block trades in Nike Air Jordans?
Okay, to be fair, we're talking, an asset class of its own here. Okay?
Sneakers are expensive.
We got stocks, we got bonds, and we got sneakers as an asset class. This story, among the most read on the Bloomberg terminal today, it's by Miss Elena Igafopoulou. She is Bloomberg News personal finance reporter.
I believe she's the sneaker reporter.
Yeah, that's actually, can we change your title?
I'll take it.
Okay.
I'll take it.
Okay, we'll call you that. We also got with us the editor of Bloomberg Business Week, Joel Weber.
A sneaker wearer.
I wear sneakers.
Sneaker guy, right?
I like sneakers. I'm from Oregon. I know Nike. I went to school in Eugene. I'm obsessed with these stories.
So is that enough for you to go sell? Are you ready to be the guy who goes and becomes a salesman for block trades when it comes to Air Jordans? Do you have what it takes?
I hadn't gone there. I don't think I do, to be honest with you.
What does it take?
Well, that's what I want to talk to Mizzy about. So how do I get this job?
Well, really what you need is a lot of connections with key players in the sneaker industry. This is what the lawyers in this case are really looking, is someone who really knows the ins and outs of reselling sneakers. They have some 60,000 sneakers in their hands that they're trying to sell off.
All right, go back.
Yeah, so back up. This all hinges in Eugene, Oregon, that there's this Zada Kicks and there's this warehouse of shoes. What happened?
So this man who ran a pre-sale sneaker company called Zade Kicks would essentially offer really coveted sneakers to sneakerheads ahead of their release date at a discount of what they would be able to get it once they hit the market. And so he brought in a lot of sneaker fans that wanted to buy sneakers at a discount and then sell them later in the market. What happened, though, was it ended up being kind of a Ponzi scheme, like this, too good to be true story, which had red flags from the beginning, but really took a while to get to a point where it dissolved back in May. And so now the individual behind the company owes millions of dollars to people who ordered shoes and never got them. These 60,000 sneakers that we're talking about are the sneakers that are left over in his warehouse. And so his bankruptcy lawyers are hoping to sell them and through the profits try to pay some of the victims. It's never going to get to what is actually owed, but it's something.
So is there just like a spreadsheet that has the inventory and the sizes and the models of like all the different shoes?
It has a spreadsheet of the different shoe brands. We don't know the individual models yet, which is very key, Joel, because obviously, some sneakers can go for like thousands of dollars. Some can go for a couple $100. So really, that's why we need a sneaker expert here, so they can really identify what the worth of these sneakers are and try to get them on the market for the highest price.
So how is this going to break down? Like, do you get to know the model of the sneaker, or you just have to like blind bid? I'll take it all.
He does want the job. You can tell.
So yeah, you really do. You're vouching for it, and I think you're doing
just asking
great.
on behalf of a friend.
Missy, do you know anyone who could
Asking
kind of
for a
hook him up,
friend,
maybe?
I think the way this is going to work is, they're talking about doing this wholesale, because doing it individually per sneaker, like, it's just going to be too costly, and they're really trying to minimize cost here as much as possible and get as much money back to victims. And so
It's literally like a sneaker grab bag. Like, what are you gonna get? Don't know. You might be able to flip it though.
Is it gonna fit?
Yeah. I think this is not really about the fit. This is like just move the product.
I think what they're doing is they're trying to photograph all the sneakers so that they can upload it to like sneaker resale platforms. So some platforms might come forward and be the ones that are gonna, list the sneakers on their websites. Still so many questions
Why don't
here.
they just give the people who lost money a pair of sneakers?
That's a great question. That's what the victims are asking. Like, why don't you just give me the sneakers? I don't really want my money back.
Yeah.
I mean, if I'm StockX out there, right? The stock exchange for things that sells sneakers, or eBay's increasingly getting into this, I'd be, kind of waving my hand saying, hey, we'll take care of this. We got the capacity to do this.
Yeah, but the question here is, do they actually pay for the sneakers up front, or do they just list them and then
Maybe
wait
get
to
a
see what the
commission.
market does? And like 60,000 sneakers, we've spoken to experts, could go anywhere from $12 million to $20 million, which again is
amount.
That's
all it took, Joel?
Sorry.
It kind of sounds like one for the private equity guys.
Yeah.
It sounded
Like
great.
they have deep
It sounded
pockets
great,
and lots
but
of cash.
So okay, if you got that much, you got that price point. How are they going to test the market?
So that's the question. I mean, what the lawyer is saying is we really want someone who's going to be able to create some competition in the market. But then we're talking to experts who are saying, if you drop 60,000 pairs of sneakers in the sneaker resale market, it's really not going to do much to move any prices. Like, the amount of sneakers traded every day is like way beyond that, right? So they're still trying to figure it out, and we're here waiting because this is taking forever.
There is like a personal part of this guy's collection of the Zadok guy, right? There's like 1,100 sneakers of his that they could test things with, right?
Yes.
Put those out, get some nibbles, get everybody jazzed about, wow, these are some cool sneaks.
That is the game plan here. And so obviously the guy behind the company was a massive sneakerhead himself. He had some really highly coveted sneakers in his personal collection. There's 1,100 of them that the lawyers are going to put out in the market first to sort of test what it would look like, and then the rest are going to start getting offloaded as well.
Can't make this stuff up.
I don't know. Who said sounds like a job for private equity? Who said that? Was that you, Carol?
No,
And Joel Weber.
Was that you, Joel?
I mean, I
Yeah.
volunteer myself. I mean, I don't think I can meet those the bids there.
I think you should apply.
Check out this story. It's on the Bloomberg Terminal. It's among the most read. Miss Lena Igafapoulou. She is personal finance reporter. She's with us right now in the Bloomberg Interactive Broker Studios. We're also having fun with Joel Weber. He is the editor of Bloomberg Business Week. You're listening to Bloomberg Business Week on Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 1061 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
You are listening to Bloomberg Business Week, live from our Bloomberg Interactive Broker Studio. Carol Masser, Tim Stenovic, we're also streaming on YouTube. And we've got an author coming up who is also the Dean of the Wharton School at the University of Pennsylvania with a very timely book, and it talks about the prepared leader.
Yeah, emerge from any crisis more resilient than before. It's co-authored with Lynn Perry Wooten, the president of Simmons University. We're talking to Erica H. James here. She's going to be joining us in just a few minutes. First up, though, Charlie Pellet, a lot of news happening, not just in the after hours, but in today's trade.
Indeed, and we love it. That's what we do here at Bloomberg Radio, and that's why you have been listening to us for decade after decade. Here's what's going on. The Dow, the S&P, NASDAQ all declined today. Wild swings. Traders overwhelmed by the many headlines that followed the Federal Reserve decision, along with Fed Chair Jay Powell's remarks. Anna Hahn is equity strategist at Wells Fargo Securities, and she was our guest right here on Bloomberg Business Week.
I think the main driver in the knee-jerk reaction was that the Fed left the door open for a 75 basis point hike next meeting. The 75 basis point hike this time was consensus, but leaving that open and perhaps the hint that we might be able to tolerate a higher employment rate with the change in the Fed's expectations for the employment rate and economic growth. All this combined seemed to signal hawkish for longer, and equities knee-jerk reaction was down.
And with more on that Fed decision and the news conference, here's Bloomberg's Vinny Del Giudice.
Fed officials are playing catch-up after underestimating the post-pandemic inflation risk. Today's move, another 75 basis points, lifts the benchmark rate to 3.25%, the highest in more than a decade. That, says Fed Chair Jerome Powell, is the very lowest level of what the central bank considers restrictive. Fed projections suggest the benchmark rate could top 4% by year end and reach 4.6% next year. Vinny Del Giudice, Bloomberg Radio.
Two-year yield today, 4.05%. 4.05 on the 2-year, the 10-year, 3.52%. The Dow, the S&P, and NASDAQ all closed at session lows. S&P down 66, a drop of 1.7%. The Dow down 522, down 1.7% as well. The NASDAQ Composite Index down 204, down 1.8%. Spot gold up 0.5%, $16.73 the ounce. West Texas Intermediate crude now at $83.04 a barrel, down 1.1%. Earnings, specifically home builders, briefly, Lennar reporting adjusted EPS for the third quarter that beat the average analyst estimate. KB Home shares lower after hours. It reported deliveries for the third quarter that missed the average analyst estimate. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You are listening and watching Bloomberg Business Week on this Fed Wednesday. Carol Masser along with Tim Stenovic. Fed Wednesday, yep, that was a big deal, but we also just came from the plaza where we were surrounded by a bunch of leaders, heads of companies, heads of state, heads of organizations, nonprofits, you
I saw
name
a governor or two there.
There were definitely a lot of politicians as well, and it made us think a lot about leadership, and our next guest has a lot to say when it comes to being a prepared leader.
We're talking about Erica H. James. She's Dean of the Wharton School at the University of Pennsylvania. She joins us now via Zoom from Philadelphia. You heard it before, but it's worth repeating. New book written along with Lynn Perry Wooten is The Prepared Leader, Emerge from Any Crisis More Resilient Than Before. Erica, it's good to have you on at Bloomberg Business Week. How are you?
I'm great. Tim, Carol, thanks for having me.
Yeah, thanks so much for joining us. So, I know that you and Lynn Wooten have done decades of research into leadership. What is the sort of common thread that ties all leaders together, whether we're talking about leaders of companies, leaders of business schools, or leaders of countries?
Well, there's more than just one common thread, but I think there are a couple that are really important. One is a focus on what you're trying to achieve. What's the outcome? What's the vision? What's the direction that you want to take your organization, your city, your unit? And then the second is the ability to communicate effectively so that people buy into what it is you are asking them to do in order to get to that outcome or get to that vision. So communication of your outcome or desired end goal are the two things that are common among all leaders.
Has there been any kind of rethink on leadership coming off the COVID pandemic? I do think, all leaders kind of took a real deep look at themselves and their strategies and how they deal with employees, especially as I feel like employees still a bit in the driver's seat at this point when you've got a lot of workers who are still saying, I'm going to work at home. I don't want to come back to the office. But tell us about kind of the impact of the pandemic.
I think the pandemic rocked everyone's world. And, what we thought to be true, the safety which we thought our universe operated in was all sort of thrown up in the wind. So I do think that leaders are thinking about their responsibilities differently. I think they're thinking about their outcomes differently. I think they're thinking about their people differently. And to your point, Carol, that rethink is being pushed a lot by employees and recognizing that they are in the driver's seat. They have a lot that they want to contribute, but they want to contribute in their own way and under their own terms. And I think leaders are now trying to come to terms with how do we manage in an environment where they were in charge, they set the rules, they set the policies, and now have to be flexible to changing demographic and changing interests of their key stakeholder.
Isn't this a good thing? Isn't this a great thing?
It is a great thing, and it will be a great thing over time. I think right now we're caught up in this middle stage where we're not quite sure where to exert influence and pressure and where to pull back. And until we sort of normalize the flexibility, until we normalize the need to listen to a variety of stakeholders and add their input into the equation of our decision making, we're going to still be going through a pretty rocky period. I would argue for a couple of years, actually.
It is interesting, too, when I think about a crisis, like it hits you, right? And you're in the midst of it, and you've got to deal with it, and you're running around, putting out fires and so on and so forth. But there are crises that, as a result, stay with a company or a leader for a long time. How do you think about that?
So in our work, we talk about two different kinds of crises. We talk about the sudden crisis, which is, as you described, something that sort of happens out of the blue. We didn't really anticipate it. And oftentimes it's an externally imposed threat. So, the weather conditions in Puerto Rico right now are a crisis for that region of the world. A terrorist attack is a crisis that happens pretty suddenly. And yet, the kinds of crises that we tend to deal with on a day-to-day basis, but never really invest in learning how to manage them well, are what we call smoldering crises. Those are those things that are internal to the organization, oftentimes a function of poor decision-making or inattention to particular issues that just bubble under the surface for quite some time until they erupt into something pretty significant. And I think both kinds of crises matter, and we need to be responsive to them, but we tend to create practices around the sudden crises and less so around the smoldering ones.
We're speaking with Erica H. James, Dean of the Wharton School at the University of Pennsylvania. She's author of the new book, The Prepared Leader. Sit tight, Erica. We're going to be back with you in just a few minutes. First up, though, a check of world and national news for that. We go to Washington, D.C. and Nancy Lyons. Hey, Nance.
Thanks, Tim. President Biden is asking every nation in the UN General Assembly to stand up to Russian President Vladimir Putin for his unwarranted war on Ukraine. Biden spoke to UN leaders this morning.
Each of us in this body who's determined to uphold the principles and beliefs we pledge to defend as members of the United Nations must be clear, firm, and unwavering in our resolve.
Biden says Putin's actions should make everyone's blood run cold. New York State Attorney General Letitia James says after a 3-year investigation, she is filing a lawsuit in state court accusing Donald Trump, his children, who were officers of his companies, and his top aides of fraud. She accuses them of lying about the value of most of their properties in order to get more favorable loan terms and taxes.
James said Trump claimed his apartment had 30,000 square feet when it was really 11,000, and he did the same for his office building at 40 Wall Street.
The pattern of fraud and deception that was used by Mr. Trump and the Trump Organization for their own financial benefit is astounding. Inflating the values of assets by whatever means necessary. Claiming you have money that you do not have. It's the art of the steal.
James is asking the court to restrict the Trumps and their companies and make them pay $250 million in ill-gotten gains. She believes they violated federal as well as state laws. In Washington, Irv Chapman, Bloomberg Radio.
Hurricane Fiona is showing its staying power as it rakes the Bahamas. It's intensified to become the strongest storm of the season with winds of 130 miles an hour. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. Nancy Lyons in our 99.1 newsroom in Washington, D.C. Carol Massar, Tim Stanovic, live in our Bloomberg Interactive Broker Studio, also streaming on YouTube. So we mentioned how we had a race from the plaza after the Earthshot Prize Innovation Summit.
Only to find that we couldn't get into our building.
And so, because of the UN General Assembly, we believe that President Biden was indeed coming down Lexington. Everything was blocked off.
But
so we're
fortunately,
like, what should we do?
Fortunately, the wheels in my head started turning.
You're always thinking there.
And I thought to myself, is there a secret underground passage we could somehow go through to cross Lexington Avenue at 58th Street? And I thought, if we just have $2.75 to spare, we can go through the turnstile of the New York City subway, run underground, and emerge on the east side of Lexington Avenue.
Gotta love those uptown, downtown stations. Tim even treated me. I feel like, wow, what a lucky day.
I'm going to expense it, don't worry. You know what's not fun? Is being so, immersed in your podcast or whatever you're listening to on your way and missing your stop at 59th Street and continuing to go further north and getting to a subway where you can't actually go underground to the other side to take the downtown subway, which has happened to me several times. And
pay attention there.
Then you got to get out and pay again.
I've done that. We've all done
We've
that.
all
right?
been there.
You're like, I got to do it. So in the meantime, the reason we're going on and on about this, it's been that kind of a day. There's a story on the Bloomberg about New York City's subway stations in Manhattan and Brooklyn are seeing a boost in ridership as more workers return to offices and students head back to school. Subway usages at Manhattan's Grand Central and Penn Station up about 15% since May, according to the CEO of the Metropolitan Transportation Authority, saying that out during a monthly board meeting.
Yeah, remember the MTA is a state agency, even though it oversees the city's subways, buses, and rail commuters. I'm feeling it. Are you feeling it on the subways?
Totally. It's getting busier.
Especially Tuesday, Wednesday, Thursday. I mean, Friday's still dead.
Yeah, exactly.
That's when I can get a seat.
It's definitely up. We'll see if it continues, right?
Yeah, fingers crossed.
Or if it builds out to 5 days. All right, you are listening and watching Bloomberg Radio.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Fed Chair Jay Powell signals more pain to come. Stocks sell off. We've got the two-year yielding 4.05%. Today, Powell, you heard him on Bloomberg Radio, vowed officials would crush inflation after they raised interest rates by 75 basis points for the third straight time and signaled even more aggressive hikes ahead than investors had expected. S&P today down 66, closing at the worst level of the day, down 1.7%. The Dow down 522, also down by 1.7%. Nasdaq down 204, a decline of 1.8%. 10-year yield 3.53%, but the two-year making news today back above 4% at 4.05% on the two-year. Spot gold up $9 the ounce, up 0.5%. An ounce of the precious metal now at $16.73. West Texas Intermediate crude down 1.2%, $82.96 a barrel. A couple of home builders after the close of trading today. We did hear from Lennar. Lennar shares there up right now by roughly 0.8%. KBH, KB Home down 1.4%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Master, Tim Stanovic. We do want to get back to our guests. We're talking with Erica James, Dean of the Wharton School at the University of Pennsylvania. She and her co-writer have a new book out with Lynn Perry Wooten. It is called it's been a long day. The Prepared Leader, Emerge from Any Crisis More Resilient Than Before. Erica, one thing I wanted to ask you, we're always interested in particular leaders, and I'm curious what leaders you looked at in terms of, what do you say?
Well, I was just I'm so sorry to interrupt you, Carol.
No, don't.
There are some really good blurbs on the back of the book from familiar leaders. Roz Brewer over at Walgreens Boots Alliance, Ed Bastian at Delta, James Gorman, Chairman and CEO of Morgan Stanley. So, I mean, they've read the book.
Yeah.
But we're wondering about lessons, like, who specifically we should be looking at.
Yeah, Erica, it's just in this world, it's so fun to get some specific examples of kind of leaders that you guys have looked at who've come under pressure and had maybe their leadership tested.
Yeah, well, I mean, you named three terrific ones, all of whom were leading tremendously important organizations during the pandemic. You know that the transportation industry was thrown for a loop in the middle of the pandemic. And so what was, Ed Bastian leading Delta through that. I remember talking with a colleague at Delta who said, Erica, this was the day that our revenue basically went to zero, which meant nobody was flying anywhere on Delta Airlines. And that's a pretty tough place to come back from. He is a CEO that I admire tremendously, and what he's been able to do, both in terms of, through the pandemic, managing all of the different mandates around mask wearing, not mask wearing, the political dynamic that was a part of that conversation, managing the passengers on the plane and increased fighting and all sorts of stuff. And they handled that as well as could be expected under the circumstances. And I think part of what we saw in his leadership, for example, was a willingness to be really authentic, to talk very clearly about their decision making, why they were making their decisions, set new guidelines, allow other people in the organization to come forward with their ideas and thoughts for managing the situation, and just sort of being in the throes of this with employees to get better.
Dean James, I'm wondering if, in your classroom, you can identify, just by interacting with students, who are going to be the next CEOs?
Great question.
It is a great question. It's not a fair question. It's a good question.
No pressure. The students are listening.
Right. Yes. It's hard to know for sure, but clearly there are people who have this spark about them, who are very articulate in what it is they're trying to achieve for their life or what problem they're trying to solve. And you can tell that they will be in a significant leadership role, whether they are CEO or whether they're an entrepreneur. That's more difficult to predict. But there are some people who are just so clearly focused on contributing good into the world in some way, that you know that they're going to rise to some significant level in society.
It's so, I mean, I'm just trying to think right now about people I was in school with who
Yeah.
have, mostly high school at this point, who've like gone on to incredible careers that I would never have guessed for them. And what really, surprised me about them, and if they had that leadership style. Well,
Well,
Dean,
if
go
I
ahead.
can,
Yeah.
just to build on Tim, like, I think, is it fair to say, Erica, that people can have qualities that would make them initially put them in a position to lead something, but then it comes to maybe leaders who can do well when everything's doing well versus the leader who all of a sudden is faced with a test or a major crisis?
Well, I love that question. And one of the reasons is we tend to think that our title informs how effective we will be in a time of crisis. And that's not often the case. And in fact, sometimes it's the people who are more quiet, who are more reserved, who are readily going about their work, and who aren't the most boastful or aggressive members of your community, that are paying attention to what's going on in the world, are paying attention to what's going on in their organization. And it's that insight and that very quiet perspective that allows them to stand up in times of crisis. So the leader then needs to identify those people in the organization. And it's not always the people who hold a particular C-suite title that are going to be the most effective.
How about this one? Sorry, Tim.
That's fine.
The
Go.
brain all of a sudden has kicked in. Women versus men. Are there any qualities or any generalities that we can make that women being better in crisis management or men being better in crisis management?
Yeah, well, recognizing that, to use your word, these are generalities. But one of the things that we observed in writing The Prepared Leader is because the focus in our book was using the pandemic as a thread throughout all different types of crises, what we saw was women who brought to the pandemic a humanity and a recognition. Yes, there were health-related issues that needed to be addressed, but there were also a level of emotional issues and interpersonal dynamic issues that were part of this crisis that women brought to the forefront and surfaced in a way that many people seem to appreciate. So that's not to say that men can't or didn't do that, but generally some of the characteristics that typically describe women and women's leadership found value in this particular crisis, which I think informs how we should think about the needs that are necessary for leaders going forward.
Dean James, before we let you go, just what's one leadership lesson you can leave with our listeners and our viewers at the end of the day here?
I think the most important thing is to remember that people are at the heart of what you're doing. You're running a company, which is not just the brick and mortar, it is actually the people. You are working for people, your shareholders, your customers, your clients, and understanding what it is they need and being responsive to those needs is really, really critical. And sometimes it's very easy to get sidetracked by other things that are actually less germane, but may sort of capture your attention, and we lose sight of the fact that we need to be responsive to the people in our organizations, both our employees and our customers.
Some great advice to wrap up on this Wednesday. Hey, Erica, thank you so much. Erica James, Dean of the Wharton School at the University of Pennsylvania. Check out her new book, written with Lynn Perry-Wooten, The Prepared Leader, Emerge from Any Crisis More Resilient Than Before. It's basically like learn from the crisis.
Yeah, it's cool. But, she's a professor, but she's also a board member. She's on Morgan Stanley's board. She's on SurveyMonkey's board too. So she's got a lot of practical experience as well.
Yeah, privy to a lot of probably interesting conversations in times of real stress. That'll do it for this Fed Wednesday. For Tim Stanovic and the whole Bloomberg Business Week team, have a good and safe evening. This is Bloomberg Radio.